morning, everyone, both to those who are in the audience today and those who are watching online. Welcome to what promises to be an invaluable and fascinating conference on the importance of financial data collection and standardization. This issue has been a long time in the making. It goes without saying that the global financial system is of utmost importance in promoting economic growth and a stable world order. And we have seen the consequences of a financial system under distress. The 2008 global financial crisis proved that a seemingly small market of American mortgages targeted to subprime borrowers could morph into a set of financial instruments that caused a global recession with the potential for a depression. That crisis exposed many shortcomings in the financial regulatory system. One was the lack of data and understanding regarding who owed whom what. Financial instruments had been created, risks supposedly transferred, and hedges made that, when finally disentangled, were in fact a circular set of agreements in which tremendous risk was centralized among a small set of institutions. When those institutions started to fail, no one knew what the consequences would be. Never again is a common saying after financial crises. I wish I could stand here and tell you that we've solved financial regulation and there will never be another crisis. That would be excessively optimistic and fly in the face of economic history. What is achievable is to know who owes who what. That is, we can create a set of financial data, transfer that information to regulators, and understand the flow of liabilities and assets across the economy. That feels achievable. The economy, of course, is global. Financialization makes that possible. Financial data standards have to take into account this reality. The solution cannot exist within one sole jurisdiction. After the financial crisis in 2008, there was a broad consensus on this point. Congress had established the Office of Financial Research to standardize financial data and collect it. This office was created with this mission and given substantial power and political independence to achieve it. Other nations similarly committed themselves to this cause. A data standard called the LEI was created, and a global LEI push was underway. This spring, 15 years later, America had a banking problem. What started with a small bank called Silvergate quickly resulted in the largest banking failures since the financial crisis. Regulators scrambled to understand the scope of the risk and ultimately had to take drastic action using systemic risk exceptions to protect the financial system and the global economy. Clearly, we have more work to do. Today's conference presents the question, where are we on financial data standardization? I'm excited to hear the answer from a wide range of perspectives, both domestic and internationally. As part of this question, it is critical to understand the benefits of financial data standardization and the costs of failing to collect this information. Our various speakers will explore these and other critical topics. So I am excited to introduce them in this conference. I now turn to Aaron Klein, Miriam K. Carlander Chair and Senior Fellow in Economic Studies. Thank you.
Thank you, Ben. I also want to thank the Sloan Foundation for their generous support that makes today's conference possible. We have an all-star lineup. We have two panels. We have two keynotes. We have a lot to cover. And with that, let me waste no additional time and call the first panel up. This panel will be moderated by Gillian Tett. If you don't know who Gillian is, you're probably in the wrong room. Gillian is the U.S. Managing Editor of the Financial Times, the head of the editorial board, and I think in her spare time, the provost of King's College at Cambridge. So with that impressive understanding of the global financial architecture and a reporter's dogged background and beat, let me call Gillian up to the stage, and she will introduce our first three panelists. Please, everybody join. Come sit down, and we're going to kick this off, and I'll be back shortly. Join me in welcoming the panel.
Well, thank you very much indeed for that kind introduction. Is this working? No. Is this working now? Great. Thank you for that kind introduction. It's great to be here this morning. It does feel a bit like deja vu because, as you may know, back in 2008, I was running the financial coverage for the FT, and spend a huge amount of time lamenting the fact that, as Mike Bloomberg once said, if you can't measure it, you can't manage it. And clearly in the run-up to 2008, there were terrible data problems. After 2008, there was a widespread pledge to improve those, whether through the LEI Foundation, which Stefan Wolf is heading up, and doing extraordinarily important work in what I call creating barcodes for the financial system, essentially a unified way of telling what's going where. And I've always taken the view that if you can create barcodes for tins of baked beans and chewing gum, you should be able to do that with securities. So the LEI was launched. We also had the OFR, the Office of Financial Reporting, which was, in my view, an extraordinarily positive initiative, which has since run into challenges. We have, of course, Alan Mendelowitz, who's been involved for the federal home loan banking system for many years, and is also deeply involved in the OFR as well. He's going to be talking to us from his current perspective from Actus. And, of course, banks like JP Morgan and others on Wall Street pledged to improve their own data reporting systems. And we have Chris Wheat from JP Morgan Chase, who's going to tell us about what he's been doing or what the bank has been doing in that respect. So lots of pledges after 2008 to improve what was clearly a lamentable system. Progress has been made, and yet we've seen, as you just heard, over the last year, that there are still some big gaps in people's understanding of what's really happening in the financial system. So just how bad are these gaps? What needs to be done now? And is there any chance of the necessary action taking place? We're going to hear from all three of the panelists about what they think. Perhaps we can start with you, Alan. Tell us where you see the data gathering and data monitoring process at the moment. I'm then going to turn to Stefan, who's going to tell us both about what's happening in Europe and what's happening in the LEI world. And then Chris can give us a private sector perspective. So let's start with you, Alan.
Thanks, Gillian. I have to say I'm just thrilled that you agreed to be the moderator of this panel. It definitely elevated our ability to deal with these issues. If you go back to the 2008 collapse, there was a really interesting, I think, and maybe overlooked bit of information about what kind of problems we faced. And it related to OFEO and Fannie and Freddie, because in the middle of July of 2008, the regulator of Freddie and Fannie issued a report that said Fannie and Freddie were well capitalized. And 6 weeks later, they were in conservatorship because they were insolvent. And that's the kind of regulatory problem that we need to avoid if we're going to make real progress in improving the quality of regulatory oversight. So jump ahead 15 years to the collapse of Silicon Valley Bank. In November, according to the Barr report of 2022, the Fed gave Silicon Valley Bank its highest rating for the quality and quantity of its capital. And 10 weeks later, it collapsed. Was it 10 weeks, 12, whatever, 2-3 months. And when you look at those two observations, the rating of capital given to Freddie and Fannie in 2008, just before its collapse, and the capital rating given to Silicon Valley Bank by the Federal Reserve Board just before it collapsed, says there clearly has not been the kind of progress that we would have expected after the financial collapse of 2008. And if you look at sort of the initiatives from 2008, and I was deeply involved in the proposing the legislation, lining up legislative support, and then writing the legislation, and then negotiating it into the Dodd-Frank Act, the expectation that the OFR, when given sufficient authority and independence in a whole host of areas, would be able to make the kind of critical contribution. One requirement to make progress because the objective was to stop relying on backwards-looking static accounting data and to shift regulatory oversight to collecting data that would support forward-looking analytics so the regulators could understand how the condition of the regulated banks would change when the state of the world changed, and they'd have advanced understanding of where the risks lie in the system. And I have to tell you, the two critical components were a unique identifier for counterparties, so you would know who was who the parties were to the contracts, and a financial instrument reference database that provided at the granular level a representation of granular contracts in a standard that would support forward-looking analytics. And I have to say, when we proposed this legislation, my view was this is such a critical idea, it's such an obvious idea, it's such a beneficial idea both for regulation and for the industry. On the regulatory side, it would improve the quality of regulatory analytics in a way that couldn't be done now with the existing data sources. And at the individual financial institution level, it would, in a sense, push them to do something to comply with regulation, but it would equip them to manage their data in a way that, in fact, reduced operating costs and improved the quality of their own internal analytics. And I have to tell you, I grossly underestimated how hard it would be to have an obviously good idea generate and motivate change. Stefan has done a really wonderful job with the LEI in terms of overseeing, setting up the LEI, establishing it, implementing it, getting people to sign on. And it's such an obvious and straightforward advance. And has the Fed adopted it? No. The Fed had its own data system and said, we don't need this. Has it been widely accepted by the banks? No. When you look at the clearing and settlement of derivatives, it's all automated, of course, because the volume of trades is so high you can't possibly manage that with a manual process. And one of the problems they face that's very expensive is trade breaks. And very often the trade breaks are tied to misidentification of who the counterparties are. There's an obvious application. Has it been widely adopted? Haven't seen it. And so I will hearken back to the view of my good friend at the European Central Bank, Francis Gross, who likes to say, to make progress, real progress in regulation, it's like you need something that's like a bird with two wings. One is an identifier for counterparties, so that you know who owes whom, and then a representation of the contractual obligations in the standards that not only, and I want to add to what our introductory speaker said, you not only want to know who owes whom what, you have to know who owes whom what and when. And your risk profile is going to be very different if you have to, on a contract, pay out capital return, principal return to the lender over a period of time versus paying out, for example, the principal in a bullet payment at the maturity of the instrument. And so the key is who owes whom, what, and when. And answering that question is what the Actus Foundation has done. We've created a financial instrument reference database, or financial instrument standard for financial contracts that, in fact, generates the cash flow obligations of individual financial contracts with a high level of precision, which defines not only who owes whom what, but when as well. And when we started this project, my optimism was, here we are creating something of incredibly great value. It's open source, and it's free. And it did not occur to me at the beginning of this journey that it would be so hard to give away something of such great value that was free. So where are we? Going back to my first comments about Fannie and Freddie and what the regulator had to say about their condition, and Silicon Valley Bank 15 years later, what the Federal Reserve said about their condition. And I have to say, we have not made anywhere near as much progress as we have to make. We are still vulnerable to over-reliance on static, backwards-looking data, when what we have to be doing is having a system that allows us to understand what the forward-looking analysis can tell us about how the condition of the regulated markets and institutions will change when the state of the world changes.
Well, thank you. That's a very trenchant, forceful argument for why change is needed. Just before we turn to Stefan to ask about the LEI, just on the Silicon Valley collapse, though, I mean, it seems to me that the biggest problem for the Fed, the reason it got it wrong, was simply that it couldn't imagine that the hallowed Treasury bond, the government bond, which of course didn't require any risk capital, could possibly go wrong. And that's partly inability of the government to imagine that its own policies might have created problems with, U.S. sovereign debt. And a sort of doublethink or a blindness in that respect. Do you really think that having an LEI would have avoided, or LEI in widespread use would have avoided that problem at Silicon Valley Bank? Rather than the much more basic question of, I was actually going to ask Alan that, not Stefan that, but maybe as a non-American you can comment on that. But the inability of the Fed to recognise its own policies might have created the problems. Do you not think that was the issue? And then I'll ask Chris.
What was so remarkable about the Silicon Valley Bank collapse is that it was related to interest rate risk. And if you go back to the 1980s, when the savings and loan industry in the United States collapsed, that collapse was tied virtually 100% to interest rate risk. Now, the difference between the S&L collapse in the 1980s and Silicon Valley's collapse in 2023 is that in the 1980s, interest rate risk was not well understood. And the response, of course, to the S&L industry collapse was the creation of the first models for understanding risk. One of them created by Jeff Braswell here, Radar. The second one created by Willy Brammertz, which was called IRIS. And these models and their competitors provided great insight, among other things, into interest rate risk. The fact that 40 years after the S&L crisis, we had a bank collapsing over interest rate risk is totally incomprehensible to me, because it means the lessons that were learned 40 years ago somehow got lost and forgotten over the succeeding 40 years.
Absolutely. So, Stefan, tell us what you're doing with the LEI, because when I first wrote about this, when we first talked several years ago, to explain what you were doing to my colleagues, I used to talk a lot about barcodes and the retail industry and the way that a standardized system for tracking the movement of chewing gum or baked beans or anything else had really transformed the retail sector, and saying, well, in a world where we have so much, digital data monitoring that Google knows what we all had for breakfast each day, surely we should be able to track what's happening in finance. But how is the LEI project going? I mean, has it taken off?
So we're almost 10 years in its implementation. Actually, the first LEIs were issued as CS code in 2012-ish, something in the United States. I would consider the LEI system as it is today a huge success. This is what I hear from the market. People are very pleased with it. And just an anecdotal fact, when ESMA, the European securities regulators, took the LEI to the next level, where they mandated the LEI for all security types, for all traders, issuers, and so forth, the industry was, really pushing back and saying, oh, this is way over the top, and we can't do this, and it's too expensive, and all these kinds of arguments. Now we hear now from the regulators that the same people from the same industry come back to them today and say, well, actually it wasn't a bad idea in the first place, so thank you very much for doing it. So the LEI today, 2.4 million LEIs out there, so that's roughly 90% of the global market capitalization. So I would say we cover the big ones, and the challenge for the next decade is to go into the SME space and the non-listed companies, if I may say so. Maybe we start with the M and not with the S, so the mid-sized companies, but we believe that there is a huge demand and huge appetite for doing that. And I would like to, in reflection what Alan said, I'm getting often the question, what's the next big crisis that the LEI could prevent? If I would know that, I would bet on this crisis and make a fortune. So we don't know what the next crisis is going to look like. But from my experience, I would like to highlight 3 areas where more transparency is needed, desperately needed, on a global scale. Number 1, anti-money laundering and terrorist financing. It's a big topic right now. FATF is looking into the new travel rule, recommendation 16. We hope that the LEI is going to be recognized there for the first time. We got lots of support also from the industry. The Financial Stability Board mentioned the LEI for cross-border payments as a useful tool. So we believe that is an area of great interest where the LEI could help, because let's face it, the bad guys are always hiding behind their vehicles. So you need to know both. You need to know the beneficiary owner, but you also need to know the vehicles that they're using on a global scale. One last sentence about AML. There was a project, Aurora, from the BIS, the Bank of International Settlement, and they clearly used modeling techniques on synthetic data, but they could prove that you cannot defend anti-money laundering on a national scheme alone. You need a global coverage because people shovel around the money from country to country quite easily these days. So that's topic number 1, AML. The next one is supply chain. You talked about the barcode. The barcode is for products, right? The LEI is for companies. But an analogy of the barcode in finance would be the QC, but the ISIN codes, or the FIGI codes and things like that. And we do mappings to those codes. But coming back to supply chain, what's really interesting is when we talk with regulatory community all around the world, including US Customs, including China, Europe and so on, is the need to get more clarity on supply chains. And the big topic here is sustainability, which is a big agenda topic. Many countries have a different opinion on what ESG means to them. But by and large, we all know that if you want to do something, for lowering the carbon footprint and all kinds of other, social elements there, we need to get more transparency on this time, not know your customer, but know your supplier and know your supplier's suppliers. That's the next big thing. And the third major trend that we see that, in my opinion, also requires LEIs is what's called the digitalization of our economy. And what does digitalization mean? It doesn't mean more computers. We have computers for the last 50 years. But what digitalization really means is that you take apart processes and workflows across entities, and including government entities. You reassemble them in a different way, sometimes even with different players, and you make all the data machine readable. So no more paper, no more PDFs and things like that, machine readable data for which you need taxonomies and models and ontologies, whatever you prefer. But that is, in my opinion, the second largest part where the global economy, and each country is part of the global economy, needs the LEI. And maybe that is my answer to your question today. I don't know the next crisis. Could the LEI have prevented the failure in California? I don't think so. But the LEI certainly have helped to get more clarity and transparency in days and weeks rather than months and years. So I think that the LEI probably had a positive impact there as well.
Right. That's fascinating. Just to quickly clarify those numbers again. So you said 2.4 million enterprises covered. That's 90% of market cap. Is that globally, or does that include China as well, for example?
It's global, but when you look at the Chinese economy, it's pretty much SME-based.
Right.
So they have like 35 million legal entities on file,
Right.
of which only a few are listed and also engaged in capital market transactions.
Right. Well, obviously, for things like supply chains, particularly from an ESG perspective, a lot of that, depends on SMEs in Asia and elsewhere.
To your point, I mean, Europe, the first big regulation was the Dodd-Frank Act in the United States for derivatives and swap dealers and so forth. And I think the whole world has followed that example. I mean, Japan is going to bring out a rule next year, or implement the rule next year, the last big country. So derivatives markets, check. ESMA in Europe took it further, as I said, to the capital and money markets in general, which was a big surge in LEI numbers. This alone brought over 1 million LEIs from all around the world, because even the Philippine, gold miner must have an LEI if their stock is traded in Europe. So that's simple. And but what we have seen lately is that the fastest growing economies in terms of LEI growth are India and China. Both are growing faster than the rest of the world. We got from almost nowhere to over 100,000 LEIs in China just in a few years, in a couple of years, 3 years or so, right? Which is amazing. And India is insofar setting a role model or standard, if you like, because India adopted the payment standard ISO 20022, and they mandated the LEI for payment messages already. So in India, this is also already a reality, that the LEI is used even domestically for identifying counterparties in payment transactions. They have used a very intelligent model. They said, payment transactions with counterparties over a certain threshold, then they must have an LEI. So to protect a little bit, the smaller firms, but they're going to lower this threshold over time to bring more and more people into the system.
That's fascinating. Gosh, I didn't know that at all. Really fascinating. Suggests that, Californian regulators and elsewhere should be looking to India for inspiration right now.
Well, the payments community certainly does.
Fascinating. So, Chris, give us a private sector perspective, because I know that, after many sessions talking to Jamie Dimon, your boss, after the 2008 financial crisis, he's still there, one of the great survivors. He told me at great length about all the stuff that the bank was doing to improve its data collection and monitoring, and, how he basically loved to get really geeky about, tracking all these flows and things like that. So I'm sure you have your work cut out, or have had your work cut out. Is JP Morgan Chase, embracing LEIs? And what are you doing on the data collection side to be more forward-looking, not backward-looking, as Alan says?
Yeah, it's a great question. I feel like I should stipulate maybe several things. It's always dangerous to speak on behalf of the leaders of your firm, so I can only speak on behalf of myself.
I'm sure you can speak for Jamie Dimon. We won't hold it against
Sure,
you.
Yes. Look, let me first kind of give some context to sort of what it is that we do, because I think it very much colors the way I think about some of the questions you put on the table in both Alan and Stefan, kind of what you said. I lead the JP Morgan Chase Institute, a smallish part of a largish bank. And not for nothing, the institute was founded, approximately 10 years ago, in sort of the wake of some of I think, the recognition of the opportunity that the flow of information, data, and insights sort of from within the financial community, sort of outside of it, was lacking somewhat, and there were missed opportunities to use that information to help better inform sort of what's happening in the world in sort of in a more real-time way, if not actually real-time. It's interesting to be a part of this conversation, in part because most of what we do is like mildly overlapping with this conversation, right? The weight of our work is consumer finance, where the entities that we're talking about are households more so than large businesses, for sure. We certainly have done a bunch of work in the SME area and intend to grow sort of into larger businesses. We have done some work in financial markets, but it hasn't really been the greatest weight of what we've done. There are two places where I think our arc over those last 9 years or so touches this conversation. One is, or maybe it's both at the same time. We continue to have an aspiration that is consistent with our founding mission, which was to try to putting aside sort of connectivity between banks and other entities, just use the data that we have on our customer and clients to paint a partial picture of the interconnectedness of the world. So the idea of wanting to understand, is this entity over here the same as this entity over there, even in the context of a relatively retail part of the economy, like when we see a transaction that is happening at a business with a credit card by a consumer, it would be really helpful for this vision to be able to know that, oh, we also bank that same small business often to understand the flows of finance to the economy. We had many research proposals early days that were stipulated based on our ability to sort of make a lot of progress on that, and it has been quite slow, quite frankly. I've been there for about 8 years. I've been quite invested in sort of improving our understanding of the firm's data infrastructure and our ability to exploit that. And it has been marches in the right direction. But when I sort of hear you express surprise about the pace of something that seems so straightforwardly useful, again, I don't know that I can speak to exactly the whys, but I can certainly speak to the fact on the ground that it has been progress moving the direction where now we are in a much better position, and I would say so too our partners within the bank, of moving from a perspective of this is my business, I run card, I run deposit, and making sure that internally those data make sense, to having more connected view across the firm. So it has made progress, but it has taken some time to do that, and I think we've gotten better at it, and it helps us do our work. But it's an ongoing process, and it's been a little bit surprising to see how long it's taken. So those are sort of the two pieces at the same time. We are deeply interested in understanding the connectivity of the economy. We are, you sort of talked about you moving in the direction of SME. We are sort of moving in the other direction because there's so many things that we can't understand without understanding how players in the U.S. economy fit into the broader economy, especially through supply chains. And we have a lot of questions we'd like to ask as we sort of move on to those data. So maybe we'll see each other passing in the other direction, right? The interest, I think, is wholly there. The movement has been directionally, I think, in the right way. The technical problem of solving with the data that we have, particularly at this end that is kind of more mushy and retail, where like in the U.S. we don't have an infrastructure that produces as many sort of fixed identifiers, particularly like in the SME space where I spent most of my time, that you might have in another country. The registration processes are quite fragmented. You sort of you register with the county, with the city, with the state. Not so much of a federal process around the SME in any way. But we're making progress. It's just been
slower than
slow.
wanted.
Yeah.
Yeah, no, it's fascinating. We're going to turn to the audience for questions. Before I do, I had one quick question I wanted to ask Alan, which is, what is happening with the OFR? Because that was launched with great excitement. I thought that was going to provide one way to really track the plumbing of the system in real time. Has it lived up to its billing?
You have to, it's a difficult question to answer because of the complexity of forces that have been at play. When the Trump administration took office, the OFR was on the hit list of the Republican Party. Their budgets were cut. They dramatically reduced the size of the staff. They basically threw a spanner into the works. And it's very hard to get an organization to start out with, difficult challenges, and the OFR had a very difficult challenge because of all the bureaucratic opposition they were known to have to face within the regulatory community. Nobody likes to give up their turf. Nobody likes to have anybody else mucking around in their turf. And so between the problems with I would say, hostility from the regulatory community on the one hand, and the Trump administration's initiative to basically kill the agency by slowly starving it to death, they've had a tough row. Now, they haven't been able to succeed in doing what we wanted, as their primary mission, which was to get the regulatory community to shift to the collection of granular transaction and position data in a standard that supports forward-looking analytics. But with this administration, I think they've made some good progress, in particular with the area of climate risk. There really was not a lot invested in climate risk in the regulatory community, so they in fact are now in the catbird seat with respect to climate risk because they're creating a central data store and analytical capability which one doesn't impinge on what somebody else is doing and in fact is unique. But we still face the central problem with regulation. And regulation as practice across the government and all the agencies is still dominated by backwards-looking data and analytics. And if you go to a regulated financial institution and you look at how they comply with regulatory requirements, it's really interesting. You know, in my view, regulators should have access to the same analytics used by the C-suite executives in a financial institution so that the C-suite executives can figure out how best to position their institution, and the regulators should have the best insight into what the risk really is. But that's not how it works. In a financial institution, there is a stovepipe that in fact, whose charge is regulatory compliance. And what does regulatory compliance mean? It means giving the regulator what the regulator asks for, rather than arguing with the regulator as to whether any of it makes sense. The mandate for the regulatory compliance folks is to minimize regulatory risk, and that means making the regulators happy. And when I was heading a regulatory agency, one of the things I did was go around, talk to the C-suite executives of the banks we regulated. And one of the questions I asked them was, do you use any of the reports you file with your regulator to help you understand the risk on your balance sheet and to manage your institution? And I had the same reaction from every one of them. When they stopped laughing, I realized what a ridiculous question it was. So, you know, the challenge is a challenge for the entire regulatory infrastructure in government, and the challenge is the way in which regulated financial institutions comply with regulatory oversight. I mean, they should, you know, in a perfect world, in a world that makes sense to me, they should be working together. The bank should be helping the regulator better understand the risk, and the regulators should be thinking about how to reduce regulatory requirements and reporting that are in fact a deadweight loss. They don't really contribute to significant improvement, and focus on, you know, how to stay on top of forward-looking risk analytics and how to reduce on-site supervision to only those things that can only be done with on-site supervision.
Right. I mean, just very quickly, Chris, maybe I'm fair to ask you this, but I mean, do you know what kind of data JP Morgan Chase is handing to regulators? I mean, do you have, sorry, let me start again. Chris, might be unfair, I've given you a chance to think about this before I ask the question in a way that you can hear. Do you know, and this may not be in your bailiwick, but do you know what data you're giving to the regulators? And do you have any back and forth with them as to whether it's the right data?
Right, that's right. It's not really the way that we work, so I wouldn't have the best lens on that. We sometimes engage with lots of folks across the government who are trying to understand the financial system as a whole, including OFR from time to time, right? So we will talk about the data that we're doing research on as we're thinking about those insights. And again, we've made progress on doing that, on that hard problem. But that would be more the perspective we have. We don't sort of line directly up with the flows.
Right, presumably it's a different department, isn't it? That's actually...
It's a different department.
Yeah, that's again part of the problem. To go back to Alan's point, you have one department doing data collection, another department doing interface with regulators, and that's part of the challenge of trying to create a joined up approach.
I mean, that is largely correct. I mean, I would say across the bank, there is an inclination to make sure that we are aligned on the things that we are seeing and reporting. I mean, I think that's just sort of like good financial practice, and we wouldn't want, we make quite significant efforts when we are characterizing the largely U.S. economy as we see it to the world to make sure that that sort of ties out to what the business is seeing, since we have lots of people commenting on that. So I wouldn't want to understate the efforts that I make to make sure that the views align, but I think it's quite a bit of a different question than what Alan's talking about is the question being teed up within a regulatory framework? That seems like quite a different question.
Absolutely. Yeah. Well, let's go to the audience for some questions. I've got lots more questions myself, but I know there's got a number of people in the audience who are very well versed in this field, and we got one hand up there already. It would be courteous, but not compulsory, to identify yourself, and please keep your comments directed.
Hi, John Orvek with FDIC. Any views on the state of play with hosted, for purposes of the LEI, hosted branches on a cross-border basis, whether there's granularity on that level, and then the state of play on beneficial interests in relative to...
So the second one, state of play on?
Beneficial interests.
Beneficial interests, right. That's one for you, Stefan. What about cross-border data and beneficial interests?
So, first of all, the organization that I run is responsible for the implementation and the compliance and the quality and of the services and the data and so on and so forth. But the regulatory community is responsible for making the necessary policy decisions. It's very important to see that we have a three-tier model, with the issuers of LEIs, us being the manager of the network, and the regulators not just doing the oversight, but also issuing policy. And your question was partially answered perhaps a few years ago when the regulators issued a policy on branches. But they made a deliberate choice only to allow one international branch per country. And, other systems like the big systems from SWIFT and so on, they allow multiple branches per country. And that is part of the discussion that is happening among the regulators, actually, on, what type of relationships, what kind of ownership relationship we're going to support in the future. And when it comes to, and I interpret your question like beneficiary ownership information, the LEI is not for natural persons. The LEI is only for legal persons. So we do not carry or capture information on beneficiary owners. However, we're working together with a number of organizations doing exactly that. And I would like to highlight our cooperation with Open Corporates, Open Sanctions, and Open Ownership. And they provide this type of information when available to the public.
Right. Question right at the back.
Hi, I'm Luke Ashton. I'm a regulatory economist with HData. I had a question for Alan, and your comment on you talking to C-suite executives and saying like, hey, you give all this information to a regulator and then they kind of laugh it off like that. They actually use that data. We tend to work at HData in the regulated energy industry, and we've almost had an opposite reaction where I'll talk to a lot of our customers on the energy sector who are C-suite executives, and they say, wow, we give this amount of data to the FERC, the Federal Energy Regulatory Commission, or the EIA, or the EPA. I didn't realize we gave that much information. And that kind of got me thinking, how good is the interagency or inter-industry communication in trying to share tips and tricks and other good information? Are there any organizations or initiatives right now that are promoting that, maybe even around, say, like the Financial Data Transparency Act, as that's starting to get implemented? Are there any good kind of areas that are promoting that intercommunication to be able to share those benefits?
That's one way of saying, how good is Washington at breaking down tribal allegiances and silo busting? Over to you, Alan.
It's really big. It's a big question.
I don't want to disappoint you or call into question the things I've said about financial regulation by talking about things I actually know very little about. And, as I said, my focus has been on regulation of financial institutions and markets. I quite honestly would prefer not to say anything about data collection in the environmental world or the energy world, primarily because I probably know less than you, and I only know as much as anyone who reads the paper and sees articles about those things.
I have to say I find the topic fascinating because my second to last book was called The Silo Effect, arguing that in fact, tribalism and fragmentation and tunnel vision was one of the big problems behind the financial crisis and plays out in many, many areas too. But yeah, we got to have a question over there.
Hi, Elizabeth Jacobs from E3G, and I think this will play into build on the other questions. There's a current data collection being proposed by U.S. Treasury Department for the insurance information, and which is also getting some opposition. So this goes both to collecting from the industry and then hoping that this information can then be fed into a cross-agency consideration. Any views or takes on issues related to that? And again, it's something that would go into the climate matrix. Thanks.
I think I'll hear Alan from that. And also, I'd love to hear Stefan as to whether insurance companies let's start with you, Stefan, while Alan's thinking. Are insurance companies included in the LEIs? Are they taking part in this?
Yes, very many of them, and we see a lot of regulation all around the world on insurance companies, also asset managers and all the related functions. That is a big thing. But to your point in general, let me make this remark. Ronald Reagan 35 years ago said, "Mr. Gorbachev, tear down this wall." And now we are in charge to tear down the walls between the silos, right? And the only way of doing that is interoperability, common denominators, common data standards, and things like that. So there's a lot that we have to do.
Yeah, no, that's a very good point. It's one reason why I know I keep banging on about the barcode idea, but when I was trying to explain the concept of the LEI to my colleagues in the media world and explain why we should be putting this on the front page, not burying it in the back where acronyms go to die, I kept saying you've got to understand it's like a barcode and think about how barcodes and containerization changed the world.
And the
with standardization. I take your point about enterprise, not product, but
see the opportunity here with the Financial Data Transparency Act. When this bill passed the houses, there is now the need for the agencies, the FSOC agencies, to working together and to come up with common data standards. So people have started to realize the issue, and hopefully we will see good implementation in the next coming years.
Yeah, I really do think a part of the battle is around communication and explaining to people why it's so important. The other metaphor that I know that some US officials used was the fire hose system in America, and the fact that until you had standardized fire hose sizes, houses were burning down because you couldn't get the fire hose to actually connect up to the, I know, anyone who's involved in the data world and standardization nods because they know about this story, but anyone who's got to sell this whole idea to politicians or the public, I'd recommend you go and look into the history of fire hoses and standardization and why standardization matters. Anyway, Alan.
When you talk about a standard is only of value in terms of what it makes possible. And you can have folks out there making standards, and they can comply with all the best principles for how you make a good standard. But if it doesn't produce a result that, in fact, enables you to carry out your mission, it's a worthless standard. And, in line with what you said about the fire hoses, a few decades back, there was a dramatic reduction in mortality in surgery in the United States. And that reduction in mortality was credited to an engineer, not to a doctor or a medical researcher. And what was this engineer's contribution? Very simple. It turns out a lot of the deaths in surgery were related to the fact that the intubation equipment and the hoses and everything, you could hook them up backwards. They were all had the same size. And his innovation was to change the sizes of the ends of the various tubes and hoses so that, in fact, you couldn't hook them up backwards. You could hook them up only in one way. And I think that we have to keep that in mind. What is the objective of the Actus Foundation with respect to altering the regulatory market? It's very simple. We want the regulatory community to be equipped with the ability to do a much better job of understanding risk. And in order to do that, what they need to do is collect granular transaction and position data in a standard that supports analytics. And with the data collected in this standard, they have the ability to create digital twins of the institutions that they supervise. And when I say digital twins, it means a digital twin of the balance sheet. And once they have that, they can subject it to all sorts of analytics. In the area of insurance, we have a really interesting challenge because under the McCarran-Ferguson Act of 1947, the insurance industry gets exemptions from antitrust laws as long as they're regulated by states. And so we have 50 states and the District of Columbia, each with their own supervisory system for insurance, which means there's wide diversity with respect to legal authorities, there's wide diversity with respect to resources, there's wide diversity with respect to the staff and the ability to execute their regulatory responsibilities. Dodd-Frank tiptoed into this. There is a Office of Insurance in the Treasury Department. There's presence of insurance in the Interagency Financial Stability Committee. Is that what it's called? Financial Stability Committee?
FSOC?
FSOC, yeah.
Yeah.
Financial Stability Committee. But the federal government does not have regulatory oversight of the insurance industry. And I think that in and of itself means there's a diffusion of data and it's hard to keep track of. And if you look at what's happening in insurance, is that there are real challenges. Because of the rising climate risk in Florida, a number of insurance companies at the retail level exited the market, but much more importantly, the big reinsurers who are critical to managing risk in the insurance industry realized that they were underpricing the reinsurance they were providing. They jacked up their prices. The retailers said the retail industry felt they couldn't afford to charge rates, to increase their rates sufficiently to supply a product once the reinsurance rates went up. And you have this now, Ron DeSantis' state government now backstops a whole big chunk of the insurance on private housing in
Absolutely.
Florida.
Well, one of the great things that I find fascinating as a journalist who covered environmental issues a lot in recent years, I created a platform at the FT called Moral Money, which writes about green finance and things, is a gap in the modeling approaches used by insurance companies and small mortgage lenders. And there really was an extraordinary gap in how they were operating. And it seems that regulators weren't aware of that until quite recently. We've got two more hands over there, and we're almost out of time. So let's take both questions, and then we can have you each make some last comments.
Yeah, Jeff Braswell, Tahoe Blue. I have a question for Stefan. Maybe you could say a little bit about the movement into identifying individuals with entities with the VLEI, which I think is a very important initiative.
So tracking not just enterprises but actual people
Associating
as well.
a person
yes.
with the...
Which, of course,
with the
picks up on some of what Chris was talking about in relation to try and track that. And then let's take the other question there so we can get them all in.
Nina. Okay, Nina Rubenstein with the OCC. So Alan did mention that in the response to the question about OFR, that he's seen success in with climate risk, and that's not in my wheelhouse at all. So I was wondering if you have anything specific you had in mind in that response that is happening in climate risk space that could be scalable or repeatable in the regulatory space for some of these other data issues we've talked about.
Why don't we have you all three comment on whichever aspect you would like and share any other thoughts you have for the audience just to kind of wrap up. Why don't we start with you, Stefan?
And I like to keep my answer brief because the topic of natural person identification and digital identification is huge, But you have a good point. Regulators do not just demand financial data from corporates, they also want to know who is accountable and responsible for that data. So the CFO has to sign, the CEO has to sign, and other types of roles. And that is what we put forward as a concept, to have standards for roles in organizations. So I am Stefan Wolf, the natural person, in the role and capacity of the CEO of Glyph. And in that capacity, I can sign a contract on behalf of Glyph. In that capacity, I can file a report to the regulators. That I'm also a member in a sports club somewhere else, which is a different role, has no meaning in this context. So it's the roles that are important for financial regulation, in our opinion. And this is going to be, or is being picked up by regulators all around the world, this concept.
That's fascinating. Chris, do you want to comment on both the question about individuals? Because as you said earlier, one of the challenges for JP Morgan Chase is to try and track what's happening by individual customer level. And whether you want to share anything that you're doing on the climate risk side, because I do know that you've been doing some quite interesting, as a bank, quite innovative modeling on that front.
And I'll try to keep, again, these sort of relatively contained. I almost wanted to understand, you probably said most of what I would have said on this individual. It's complex because the information that you might try to pull from, again, isn't so fundamentally standardized in the U.S. necessarily, and I won't speak so much. I know it is more so in other countries than in the U.S. for sure. I kind of noted that the progress in this kind of area has been slow, and it is in part because the problem is quite hard, and probably didn't emphasize that as much as I might have. But it has been quite interesting to see, at least in sort of the private market response to this problem, like the proliferation of tools that are trying to make progress in this area, some of which we, of course, explore internally. It's been really quite interesting. I don't want to sort of sprinkle AI dust on yet another conversation, but for sure, it's been, you can see that there might be opportunities to make progress with approximate identification, which, again, is a little bit of the color of why this is so hard. For some of these conversations, being like pretty sure but not entirely sure maybe isn't enough. But that's part of what has made the journey kind of hard for a long time. The Institute doesn't do, the firm, of course, does a huge amount in the climate space. The little piece that we touch is mostly how climate change might affect like household economics and such. And so we have a project in flight now we hope to get out soon.
Right.
But that's more our lens on that question, which we think is a super interesting, understudied question. But that's more of where we sit on the question.
And I should also commend that, because one of the things, again, good innovations that's happened post-2008 is JP Morgan Chase has started releasing a lot of the data that it collects and crunching it in a way that, people outside the bank and economists can actually track as well. And that's been a very useful contribution towards anyone looking to make sense of the UK economy, the US economy in real time, and the UK economy in real time, but the US economy in real time. So, so I should, give some kudos to you for doing that. Alan, any last thoughts?
Yeah, Hy Minsky built his reputation by making the case that financial markets are inherently unstable. And I think most people agree with that these days. Secondly, financial collapses are extremely disruptive and costly. And all sorts of perverse incentives are built into the system where you monetize the gains privately and you absorb the cost socially. And so, this issue of risk in the financial institutions and markets remains a major concern and a major issue that has to be addressed. Unlike many of the problems we face, if you look at into the healthcare sector, there are all sorts of diseases for which there's no cure and no preventive, and there's a tremendous amount of research being devoted to try to address those gaps. When it comes to improving the oversight and stability of financial institutions and markets, We understand exactly how to do it. The challenge is not what we have to do. The challenge is getting everyone on board and doing it. And that means the regulatory community and financial institutions. If we don't, going forward, nothing will change. And as my good friend Alex Pollock noted with the title of his most recent book, Fooled Again, we will continue to be fooled again with respect to the emergence of financial market crises. So we know how to do it. We know what's required. It just takes some willpower. And the amazing thing about it is that it will be very beneficial to everyone.
Well, I guess one way to summarize that is to say at the end of the day, it's not just about numbers, data, people, numbers and money and data. It's also about people and the political economy, which as ever remains a challenge in Washington. But the reality is that since 2008, a lot has happened. When the LEI was first set up, once I persuaded my colleagues to pay attention to it under this barcode analogy, we were quite cynical about whether it would actually even take off properly. The fact you've now got 90% of the companies by market cap covered is striking. It's a sign of progress. Not as fast as people would like, but it definitely is progress. But still, a lot more to do. So thank you all very much indeed for your thoughts. Thank you all for your participation and the great questions. And best of luck, Alan and others, in changing Washington's political economy. Thank you.
And Jillian, our appreciation to you for an outstanding moderator's contributions.
I believe on the program you now have coffee, I think, if that's right. So I'm sure everyone needs one now.
benefit of having such a fantastic audience of serious people is everybody wants to say hi and engage in substantive and spirited conversation, but the show must go on. And with that, it is my great privilege and honor to introduce Senator Jack Reed. Senator Reed is the chairman of the Armed Services Committee. In that role, he is really the Senate at its best, a legislative workhorse, a senator who gets things done, as witnessed by the passage yesterday of the National Defense Authorization Act with 87 votes. Quite a legislative accomplishment in this day and age with congressional polarization. Senator Reed is also the longest tenured, most senior member of the Senate Banking, Housing, and Urban Affairs Committee, where I had the honor and privilege of watching him for over 8+ years as a staffer on the committee, where I saw him chair multiple subcommittees, shepherd through multiple pieces of legislation, and work with the skill and insight that is really public service in the United States Senate at its best. A sharp legislator with core values, a willingness to get in the details, and a skill and ability to make compromise to bring legislation to move society forward. Senator Reed, for those of you who are in the weeds on this and remember your Dodd-Frank history, is really the legislative father of what became the Office of Financial Research, and truly a great patriot and wonderful American. And with that, it's my great privilege and honor to give the podium to him. Senator Reed, the floor is yours.
Thank you. Well, thank you very much. Thank you, Aaron, for your friendship over many years and your great skill on the committee and for your kind introduction. And it's a pleasure to join you all to discuss the Office of Financial Research, or OFR. I'd like to first thank a spiritual mentor, and Alan Mendelowitz. Alan worked with me back when we were putting together the OFR. And in May 2010, as Congress was debating what we should do with Dodd-Frank, he wrote a very compelling op-ed piece, which I'd like to share a bit from. He wrote, "The OFR will enable regulators to better understand complex financial products, more effectively uncover fraud, better monitor risks from large financial institutions, and for the first time see the critical linkages between important institutions in the market. Only the most ardent opponent of regulation would oppose providing regulators and policymakers with the data, research, and monitoring tools needed to provide for the safety and security of our financial markets. The cost of regulators continuing to fly blind is a cost that the U.S. taxpayer cannot afford." Alan's argument explaining the need for the OFR remains true today, and perhaps even more compelling. And his argument raises an important question that will frame my remarks. Are we still flying blind? For starters, the OFR cannot see into the dark corners of financial markets unless there is a permanent confirmed director. I follow the New England Patriots. When you have a great quarterback and a great coach, you win Super Bowls. When you have a great coach, you're 2-10. We need a quarterback at the OFR. And after the Trump-appointed director resigned in February of 2022, the president nominated Ron Borzakowski, who's here, and who came before our committee and was extremely impressive. He was passed out of committee on a strictly partisan vote, which I don't think represents his qualifications, and still waiting for confirmation. We are going to energize the process. That's my job, and get him confirmed, because without a leader, someone with the credibility that Ron has, both intellectually and in terms of a nonpartisan or real expert in the field, we're not going to get the process moving. So that's job one. And also it reflects, frankly, some of the dysfunctionality of the Senate, where we get very qualified people who are just caught up in the pushing and shoving between both sides without any real substantive disagreements. But we are going to move forward. I think we've got the right job and for Ron, and Ron's going to do a great job. But it's going to just take more than leadership there. The next director, Ron Borzakowski, will have the Herculean task to ensure that OFR finally has an independent capacity to ring the alarm bell. In Dodd-Frank, I worked hard, along with Alan, to give the OFR autonomy from the appropriations process, which has so often been used to hamstring regulators. The challenge for OFR now is to find its own voice, exercise greater independence from the Department of Treasury, Congress, and the industry, and speak truth to power. For too long, OFR has been in the shadow of the Treasury. Indeed, Dodd-Frank established transitional oversight procedures for Treasury to stand up the office. But these transitional policies and processes have become more permanent than transitional. And we have to ensure that there is a transition to an independent OFR. For too long, the OFR director has reported to the Undersecretary for Domestic Finance. And in a way, it's become ingrained now into the culture of Treasury rather than as independent as we anticipated it when we drafted the legislation. And because the first OFR director's position stayed unfilled for 2.5 years, which was not accidental, the Treasury Department played a more significant role in standing up the agency and shaping its work, such as the asset management study in 2013, which was a low point, that we have to now recognize that it should be a truly independent agency. Independence means having the ability to check the Treasury Department's work as well as other agencies' work. And there's a natural, I've observed over about 30 years here, reluctance to have other agencies check your homework. And so this is really not initially a great conspiracy. It was just some sort of bureaucratic reaction to somebody new on the block. But it's cost us, I think, significantly, and we have to fix it, and I hope we will. The leader of OFR has to have a judicious temperament, but has to have the ability and the support to speak out and criticize when necessary. And that's something I think we'll have in Ron, I think we'll have if we create a more independent situation. Now, over the long term, I hope the OFR takes more concrete steps to understand the interconnections in our financial markets. This was one of the big efforts that we wanted to pursue, having an agency that was not there to regulate, but to understand how all the parts fit together so that the regulators could have forewarning and knowledge of what might be happening. That was the concept. We gave OFR a simple mission to ensure that policymakers know who owes what to whom. Where are all the interconnections? The agency's primary purpose is to, quote, standardize the types and formats of data reported and collected. That begins by mapping cash flows on a contract-by-contract basis. That's a significant challenge, but it's one that we have to, I think, undertake. This data collection function is intended to serve as an early warning device to identify risks before they snowball into another financial crisis. After the crisis that we went through 2008 and 2009, one of the things we all resolved is never again, that we're going to have a system that have a warning device built in. And we thought we created it with OFR. I think we have conceptually, but we have to make it work. We have to make it real. And that's a challenge that is before us. If we had such data in 2008, I think we would have first able to anticipate what might have happened, but second, certainly react more effectively and efficiently. I know for those who are here, I can recall being in the Senate with Chairman Bernanke and Secretary Paulson, and looking at Chairman Bernanke's face and having the distinct sense that he was praying while he was thinking. And I said, "Oops! I think we're in a problem here." So I was and Secretary Paulson, although a bit bigger and more robust, you could tell he was a little nervous too. And reason? They didn't know what was coming and what was going, etc. They just were trying to react moment to moment. And they made some profoundly significant decisions, and by and large, very adroitly. But it was as much instinct as it was analysis. And we'd like to have more analysis than instinct. In fact, there is no analytical tool today that allows regulators to see all the exposures of each financial institution. And it's the one thing in the dark that you never figure will go wrong, that goes wrong. And there you are. So we would want the comprehensive ability of regulators to look at the transactions of institutions. By now, if we had been very diligent and better, and I will blame the Congress and myself for this, we should be in a position to have a master copy of all the legal entities in the financial system and all the financial obligations owed one to another. I know our European colleagues are trying to do that right now, and that's something we have to do. And collecting the data before the next financial crisis begins is essential, because once the crisis begins, you need a lot of luck. I'd rather have a lot of knowledge before it began. And we've learned a lesson time and time again that you just have to put this all together. In 2008, the risk from the shadow banking sector came from insurance companies like AGI that sold unregulated derivatives. Now, I think the risks in the shadow banking sector have only grown. Shadow banks are now the nation's biggest insurers, biggest landlords, and biggest lenders. And we have very little knowledge of what they're doing. They're assuming more and more risk from the regulated banking sector through exotic instruments like synthetic risk transfers. Having weathered 2008, I get nervous when I hear risk transfers. I get paranoid when I hear synthetic. So we just don't know what they're up to, and we have to know that. And if one of these shadow banks fails, understanding its interconnections with the broader financial system will be essential to containing the damage. Now, one way that the OFR could plug this data gap is by using its power to subpoena data from any financial company. And I want to be clear, this isn't about authorizing fishing expeditions or creating a pretext to rummage around the files of companies for some nuggets of information, etc. The purpose of this authority is to close gaps in public and commercially available data. The OFR uses subpoena data to perform critical functions, accessing how a financial activity, a financial market, or a financial company poses a threat to financial stability. The agency also has the authority to provide this data, quote, to the general public to increase market transparency and facilitate research on the financial system. This power is subject, as it must be, to very severe guardrails to protect intellectual property, trade secrets, and financial stability. But despite the OFR's annual reports identifying dozens of data gaps over the years, the OFR has never used its subpoena power to plug them. And I think the OFR should strongly consider using its subpoena power to close identified data gaps. I think the process of beginning to first identify the gaps very clearly and then start moving towards invocation of subpoena will set a tone that might induce voluntary cooperation on a significant scale. But as it has been over the last 10 years, simply sitting back with your arrow in the quiver has not done a lot. And a good place to start would be the shadow banking sector. If regulators face challenges with understanding the systemic consequences of relatively simple and transparent banks like SVB and Signature, they'll surely face enormous challenges if a highly leveraged and unregulated shadow bank were to fail. Well, I'm optimistic. I mean, I wouldn't have been around here this long if I wasn't. That with the right leadership, and we do have the right nominee, and staff in place, the OFR will live up to its original purpose and deliver on its core mission. The agency still has lots of work to do. It has to develop analytical and apolitical financial research that will justify its presence as a leader among regulators. We designed it to serve as the canary in the coal mine for future threats to financial systems. And we can never be in a position again where we're flying blind during a financial crisis. Taxpayers simply cannot afford economic blowups, and that's why OFR needs to develop a stronger presence. Someone once said it's not about intellect, it's about backbone. And that's probably the case. The best way to do that is to use all the tools that are Dodd-Frank, to do it in a way that's not crass and overbearing, but to synchronize those tools and to make it clear with strong leadership that this agency is going to connect all the dots. And so the next time we'll see the picture before we see the adverse consequences. And with that, I'd be very happy to try to respond to your questions. Thank you very much.
Thank you, Senator, for that fantastic set of remarks and strong call to action on many fronts. There's a lot of questions that follow from this, but let me start with something, and I'm a little nervous to do it. So, but you're the chairman of the Armed Services Committee. You're a former Army Ranger, so please don't hurt me. But the modern financial system has become a tool not just for economic growth, but for national security. When Russia invaded Ukraine, one of the major tools of response was to cut Russia out of the global payment system, to know who Russia is and to cut them out. This was our action, but by the way, other countries have thought about using the financial system against us. During the 2008 financial crisis, Russia floated to China a plan to sell off assets to globally rattle the dollar. One of the arenas of war is financial markets. This new modern world of geopolitics, financial markets are not just tools for economic growth, but are tools for national security and global security. One way to think about OFR was to be a financial intelligence agency, to provide the information and the data. You talked about flying blind in your speech and not having the information. You know, I think about the value of financial intelligence as having grown so much in its importance when you realize that the financial markets are now a greater tool of financial world. Traditionally, intelligence and national security agencies have been highly prioritized. There's been a bipartisanship, there's been a prioritization in Congress that defense comes first. But as you point out, OFR struggled for years to have a confirmed director, both on, with some congressional delay, but also frequently with administrative delays. Prior research of mine has shown that, the popular narrative is the Senate struggles to confirm people. The actual facts are each administration has taken successively longer to nominate someone, and you can't confirm a nominee that does not exist. That's not as much. I've only done that in financial cases. I think it's less the case in military. Maybe that's unfortunate.
No, I think there's been an exception this year.
Well documented. Does having a headless OFR make America less safe?
Well, I think so, and because we're not able to really get on the field without the team captain, if you will, and we're not on the field. One of the interesting things that happened when the Russians invaded the Ukraine, there was a remarkable international coalition, both military and economic, to cut off the Russians. And it looked very much like it was going to be a decisive part of the strategy in which they might have to relent because they could not survive economically. And I know the Chinese were looking very attentively at that too, because their concept of taking Taiwan, if it was met by a economic isolation, would be self-defeating. And for a few months, we had incredible cooperation. We still have great cooperation, but we had incredible effects. But the Russians have worked their way out of it through intermediaries, through third parties, through countries, et cetera. And part of that is because we don't know who's doing what with what. Once you get beyond the first level of a Russian company trading with another company, where is that going? In the same way from Iran, well, they just moved their material in, but other countries are acting as covers, if you will, for Russian trade. If we had a much more comprehensive system of identifying financial entities and their accounts, we would have a much better way of securing or preventing Russia from doing what they're doing. And frankly, it would be a significant, I think, obstacle to Chinese aspirations if they felt that their economy could be isolated or their assets identified.
Well, I mean, that really, I think, frames the debate in a stark and important way. I was, when I started supporting, I never thought my work on payment systems would earn me banishment by Russia. But, clearly it flagged some interest in the Kremlin when they added me to the list of 500 Americans banned by Russia, and I banned them back. This economic payment stuff really is becoming more and more embedded into national security. And when you then add the Chinese element, which I hadn't thought of as a much more integrated global trading partner.
But, I think one of the issues here is we tend to think in categories. And we move this through the banking committee. This is a banking issue. This has regard to Wall Street, et cetera. Even the people over in the intelligence community don't really see this, I think, as much as a potential instrument in intelligence and national security, which it can be. In fact, every day it gets more and more current. So that's part of, I think, the argument we have to make, that this is not just a wonky economic sort of group, that these people could do some significant help, if you will, for national security.
Well, when I hear wonky economic, my ears perk up, and I feel more at home.
But by the way, the only reason I'm not banned is because the Russians have me confused with John Reed, who's buried in the Kremlin. So no, not yet.
The banking turmoil in 08, which was referenced in the prior panel, where I think LEI can't solve everything for everybody, and I wouldn't have solved interest rate risk, but it might have let us know what the next domino was. We were told before the failure of SVB they were not systemic, they were not subject to heightened prudential standards, which the Federal Reserve could have. Friday, it looked at one moment like they're going through a normal bank failure. And then over the weekend, we were told that had that happened, there would have been systemic consequences, and thus a systemic risk exemption was invoked, and people were bailed out. Right after that, you and Senator Warren wrote a letter stating, and I'm going to quote, "We urge OFR to utilize the full extent of its data collection powers to address all of the data gaps it has identified," end quote. And that's a theme you returned to in your speech. How has OFR responded to your letter, and are you satisfied they're doing enough, or are we still behind the curve?
I think we're still behind. I think they are sincerely interested in doing all they can, but there are still limitations, I think, in personnel. Also, without a leader, the natural tendency is keep doing what you're doing until the boss gets on the job, and then we'll move out smartly. So I think those are factors that are affecting it. One of the things they've done, though, that they pointed out to us in their response, is that they have embraced the issue of climate data, and they are trying to incorporate that into their operations, which I think is a very good step forward. But it's not a full response, which would be ideally the identifying financial institutions, all of them, and then getting the transaction data between them and others.
So one step in that is getting legal identifying information. And we heard earlier this morning from Stefan Wolf that Europe has moved fast, and in fact now India and China are moving fast in implementing LEIs. They're among the global leaders. What do you think? How should we catch up, and what are the consequences if we don't?
Well, I think the consequences are that our adversaries will have much more knowledge of the financial system than we do, which would tend to suggest they could exploit it better than we could. They could slant it or tilt it against us better than we could. In fact, they would use it as a weapon, an economic weapon. They tend to use everything they have as a weapon. So we have to get there, and it has to be done, I think, with, first of all, the executive energy, the president indicating that this is important. And I think, frankly, we're probably going to encounter opposition because, one, anything new is, we don't want to do it. Two, I think there will just feel as if operating in the dark is better individually for the enterprise. They'll make more money that way, and hopefully it won't cost us a collapse or anything else. One parallel to this is I've put in legislation the last several years that would require the biggest private entities to essentially report as a public company. And that's not got a lot of really rousing support from the financial community. And in fact, when we start making more progress, and I think we will, we'll get more concerted opposition. And it's not, they're all very patriotic and sure, but they'll look at their own self-interest and say, I can make more in the dark than I can if I have to report everything, and they know what they're doing here and they know what they're doing there. So it's going to be a struggle, but I think the point you started with, and we keep coming back to, is this becomes national security in a world in which a global economy, the economy is a weapon too.
Well, Sarah, why don't we build on that and give me an example of something that no one is talking about in these kind of dark worlds that greater data transparency is necessary, and we would benefit from somebody kind of getting behind that dark curtain.
Well, there are a couple areas. One is and this sort of more hometown than anything else, but the increasing number of residential units that are being held by private equity firms, which can be a path to exacerbating our affordable housing crisis. And there are some enterprises that are buying significant numbers of properties, and they have a real automated operation where they don't need local realtors, they don't need local lawyers, they do evictions, they throw people out, they put people in, and it's changing the culture. It could change if it's not at least looked at closely, the culture of communities all across the country. And it's exacerbating, in many respects, the affordable housing crisis that we have everywhere. One of the biggest concerns that my constituents have is the cost of housing. That's a real problem for most people. And that's one area where not knowing who's doing what, not knowing, putting together, my God, this company owns, 35% of the housing in this particular metropolitan area. Oh, my God, and it's something much different because we all grew up where the real estate agents with a local fellow or lady on the corner, and they owned a couple of houses, or maybe they were big developers and they owned 2 or 3 apartment buildings, but that's about it.
Yeah.
That's one era, I think.
Well, I have one more question. I could keep going, but I know I recognize so many brilliant minds in the audience. I want to open it up in a second, but one final question on my end is people talk a lot about tougher regulation driving risks out of the banking system, and you talked about the shadow banking system, which is usually what people mean when risk comes out of one and into another. I think of risk like my old physics thermodynamics, right? It's harder to create or destroy, but it's easy to transfer. And so then the risk gets transferred into markets like private equity, capital markets, insurance, money market mutual funds, other private investment vehicles that are not subject to the type of prudential regulation or, in many cases, basic data reporting that financial regulators have long subject banks to. Is OFR and financial data standardization our best tool to understand where the risks are out there?
I think it's one of our important tools if we deploy it correctly. But then, of course, it is a collaborative effort between the regulatory agencies, the Federal Reserve, Comptroller, FDIC. The more coordination, collaboration that's done is, I think, best for the economy. But right now, we're lacking this basic knowledge of who are the financial players, all of them, and what kind of cards do they hold. And, you know, are people in a position where they're dangerous to the system? And if they are, what remedial action we can take properly to the law? So I just think we're at a point where sadly, we're not much further than we were when Dodd-Frank passed in terms of getting this type of information and this type of activity just firmly entrenched in our system and accepted by our system.
Let me pause and Justin, why don't I start here? And
I've long been a big fan of the idea of OFR, and it's put out some good reports, that sort of thing, but it's always had some structural issues to deal with. So say we had full funding for the agency, we had a confirmed director as we should, how does it overcome the big structural barrier that the other FSOC agencies don't want it intruding on its turf? The Fed's thinking systemic risk is our bailiwick. Maybe we'll just keep doing that. And there's a big issue with them intruding on them and still maintaining the support for the agency. How do they overcome that?
Well, I think Congress has a role to play in terms of getting this issue more central to the debate about how do we regulate overall. Two, again, simple. We have to get a director in place that has credibility, and the director has a 6-year term. So that's a long time in Washington in terms of regulatory authority. And then the resources should be there because their funding mechanism is assessments on financial institutions, so they won't fight with the OMB every day. So we have the potential. It's just that, frankly, I think the first response was bureaucratic kind of don't bother me, capture unwittingly, the way we set it up, by the Treasury, so it became a subordinate, not a independent. And then during the Trump administration, deliberate downsizing, cutting budgets, which is the hallmark of his approach to anything. And now we're back where we understand, in many respects, because we've seen things like the Silicon Valley Bank, where that shouldn't happen. We've also seeing, as Aaron's pointed out, that this is a national security issue in terms of understanding financing, cutting off financing for countries, et cetera. So I think we've got we're reestablishing the momentum to go forward. And it's going to be done, and has to be done, not as trying to stigmatize entities and scare the heck out of them. This is going to be a constructive, collaborative process, but we're not going to stop. We'll keep going, going, going. I think that's the way you begin it. And as we've demonstrated for the last 10 years, talking about this issue is a lot easier than getting it done.
Senator, my name is Mike Atkin from Semantic Arts. First of all, thank you very much for OFR. I think it's just a miracle, you and Alan. In addition to data collection and analysis and all the political problems you define, the other task is data standards. And we now have a new mechanism in the Financial Data Transparency Act that instructs all the FSOC agencies to adopt semantic standards for interoperability. Do you have hope that that's going to facilitate the progress we need in being able to do better systemic risk analysis?
No, I think that's a very good advance, because one of the things is at least having a common sort of metric for what we're talking about. And it's quite common here in the United States to have agencies with different interpretations of X. We'd like to have everyone have the same interpretation. Then we have to look overseas, because these are all generally international markets, so that we understand their metrics, and then hopefully we can come together with something which is consistent and non-disputable when you start talking about, hey, you have a problem here. You don't want to be arguing about the metrics. You want to be saying, you're right, or let me show you why I don't.
Well, if everybody here can join me in thanking Senator Reid for sharing his wisdom and his time with us, and wish you Godspeed and more success.
Thanks, Barry. Wisdom is
We'll take a short, if everybody could remain seated for a moment while the senator departs. He has to get back to the Hill, where he has to shepherd some legislation to become law. And once the senator has departed, we will take a 10-minute break. So thank everybody. And we're going to come back with our next all-star panel to get into more of the weeds of this and continue. So thank everybody. There's refreshments over there. Thank you all very much. Be back in a few. The panelists to get ready. I see them kibitzing in the back, which is always an exciting moment. But as everybody returns, and we're all still reflecting on the great words of wisdom from Senator Reid, and from our first panel earlier this morning, I'm going to introduce our second panel here, which is going to continue the conversation on the positives and negatives of data collection and the benefits and costs of action. And we really have a tremendously fantastic, diverse panel of folks from government, from academia, from industry, and choreographing this, I can think of no better person than Yilan Mui. Yilan is a familiar name to those of you who read the Washington Post and understand where our economy is going, and a familiar face to those of you who watched on CNBC, where for years she was breaking news, covering the hot story of the day, interviewing leaders on all levels and dimensions of policy. After a spectacular career in journalism, she's now moved over to the Penta Group, which is just an amalgamation of amazing people covering a variety of topics and issues, heavily in the financial services space, but also more broadly. But I'm hoping as part of that, her journalistic skills and tough questionings remain a core, I'm confident, part of her, and she'll lead this next panel. So if I can invite all three panelists up. Yilan, the floor will be yours to introduce these great folks and lead us in a deep, thoughtful conversation. So again, thank all of the panelists for joining, and I turn it over to you.
Great. Well, Erin, thank you so much for that introduction. I really appreciate it. Let me make sure on my microphone. Is that working? Great. Fantastic. Welcome back, everyone, to the Brookings Conference on Financial Data Collection and Standardization. We heard from Senator Reid earlier about how he felt like he was flying blind during the 2008 financial crisis because of a lack of good data and a lack of good information, and that resulted in risks that he was unable to spot and we were unable to spot during that time, but also to national security risks as well. So I think for this session, what we want to focus on is how far we've come since the financial crisis, what still needs to be done, and where we can still learn, and the ways that technology is already starting to change the game right under our feet. So to help us make sense of all of this, it's a very difficult task, but I'm sure our panelists are up for it. We have our experts here today. We have Sandra Lee, who is the Deputy Assistant Secretary at the Financial Stability Oversight Council, who also spent more than a decade at the New York Fed. We've got Michael Atkin of Semantic Arts, who served as an advisor to regulators in the US and in Europe. And also Kate Judge, the Harvey J. Goldschmidt Professor of Law at Columbia University. Thank you guys so much for joining us. All right, so before we get into our conversation, I want to just make sure that you all know that we do have time for questions at the end of this. The last 10 to 15 minutes or so, someone will come around with a microphone. You can also tweet about the panel today and our discussion on what is formerly known as Twitter, now known as X, with the hashtag #StandardData. So please join in that conversation as well. All right, so Sandra, we heard some scary things from Senator Reid during his remarks. So I'd like to start this session by maybe a little bit of good news. One outcome of the financial crisis is that it really sort of forged the consensus that we needed better information in order to be able to connect the dots and to spot risks, and that there's a lot that we have learned since then. So what are some of the sectors or the markets that you feel like we have been able to shine a light into in recent years, and how has that helped make the system safer?
Sure. Thanks, Yilan, and thanks for having me here today. Maybe I'll just do the standard caveat that the views expressed are here today are my own and not necessarily that of FSOC and the Treasury Department. Maybe I'll take a stab at answering your question by talking a bit about kind of the FSOC's work more broadly and our work on data. And so I think hopefully most of you know, the FSOC, like the OFR, was established under Dodd-Frank, and our key mission and mandate is to identify, assess, and mitigate potential risk to financial stability. And one of the key ways that we do that, of course, is through, and Senator Reid talked about this, collaboration and coordination among the FSOC agencies. So, and more specifically, under Secretary Yellen's leadership, the council is focused on like 4 key priorities over the past few years, including climate-related financial risk, digital assets and financial stability, treasury market, resiliency, and non-bank financial intermediation. And maybe just talking briefly about those topics. So on the non-bank intermediation front, the FSOC has done a bit of work with our hedge fund working group, which has worked to really identify significant gaps associated with hedge fund activities. Want to give significant props to the SEC and the CFTC for all the work that they've done to propose amendments to Form PF, which has been really critical in the council's ability to look at the data, obviously pull the data, and of course all the FSOC's work to kind of link the data together to ensure that the council is doing a better job to identify potential risks in the hedge fund space. More specifically on climate-related financial risk, I would note a couple years ago, the council came out with a report in 2021 focused on climate-related financial risk and specifically potential threats to financial stability. And the council has worked really hard, of course, with all the member agencies, which have worked incredibly hard to think about what are the key risks, what are the data that we need, and how can the agencies collaborate and work together to reduce duplication, pool resources, and we made quite a bit of progress with our climate-related financial risk committee. Maybe I'll close briefly by just noting in the digital asset crypto space, last October, the council published a financial stability, essentially, and digital assets report. It was required under an executive order, and we published that in October. And there were a number of key recommendations, but one of them was focused on data and capacity building, and the fact that the crypto asset space is quite opaque, and the importance of acquiring data, standardizing data, et cetera, and that was one of the key recommendations. Anyway, let me stop there.
Great. Thank you. Kate, I'm going to hopefully not push you too much on the spot, if you don't mind, but we heard Sandra outline a number of areas where FSOC is focused. Digital assets, climate, hedge funds. I want to save climate for a discussion a little bit later, but do you think that those are areas where we've been able to get greater insight and understand better through data?
I mean, the answer is yes, but that doesn't mean that there's not more progress still to be made. I think when you take it's been one of the good themes, I think, throughout today, is that if you look at where we are relative to 15 years ago, when this project really started, there actually has been, I think, incredible progress. Like we saw that with the widespread adoption, the Silent Uniform of the LEI, and a lot of these other fronts as well. I do think the revival of the hedge fund working group is also a mechanism through which you get the coordination that you're really going to need to be able to make progress on these fronts. That being said, going back to Sandra's original framing, and we do have this core challenge of non-bank financial intermediation just being a much greater part of the financial system. And we have a really important set of tools for trying to understand what is going on in that domain, but it remains far from perfect. I mean, there was a nice, actually, one of the charts in like the OFR's last financial stability report, they do a nice job of always providing a little bit of historical perspective, which I find really helpful. And one of the things they show is that the banking system, in terms of like the financial assets, went from being well over 40% to, 20 or even just shy of 20. Whereas if you look at funds and other forms of asset management, it increased more than tenfold and is now actually bigger than the banking sector. Whereas the banking sector is still subject to incredibly robust prudential regulation. And again, that's far from perfect. We've already discussed SVB multiple times today, but there's at least a set of tools there that are really robust. And I would say this administration has done an amazing job helping to really revive designation. And I think the visibility that in theory OFR, particularly when it works closely with other FSOC members, can help to create in other areas, does allow far more visibility. But considering where this, where things stood when this administration started, I don't think it's at all critical to say that there's still more work to be done in a number of these domains for us to actually know how much we need to know to understand where the risks lie.
Michael, you work a lot with industry, work directly with many banks as well. What's their perspective on the level of collaboration or coordination that's needed in order to provide the information that regulators are looking for?
I think the key to that is that most banks grew up managing activities vertically in all of their processes. So they can do their processes all this way. Right? The key now in an interconnected world is to be able to link those processes horizontally across. And banks have a view of risk from their own perspectives, their risk tolerances, what's in their books, their approach to structuring finance, et cetera, and they're all going to be different. The regulators, however, have a completely different task. They want to unravel the orientation of an individual bank and look at things in a granular way and then reassemble it in a different way to look at completely different things like degrees of interconnectedness and transitive relationships and, as Alan taught me, state contingent cash flow and collateral flow and liquidity and all of these things that relate to systemic risks. So the key for both, and I think they share this objective, is to be able to do exactly the same thing. Granular, trusted data that is reusable, that is identified, that has precise granular meaning, so they can look at multiple viewpoints as they are trying to deal with the interconnectedness of society. And that's the big challenge that we all still face.
I open this up to the panel. Where are we seeing that level of interconnectedness or that visibility into the interconnectedness? Where are we seeing the most progress on that front? You know, Senator Reid talked about the challenges that he sees in his home state around PE holdings of residential communities. So clearly that's an area that needs more work. But where are we seeing progress? Where are we seeing the most progress?
Well, I think, I'm sorry, yeah. So I'm a standards geek, so I'm going to answer the question as in I think the most progress has been on the development of data standards. And let me just take you through a little bit of a journey that I think we see, right? So Dodd-Frank Title I was really clear and well-written, basically specified that we needed standards for instruments and entities, started the ball rolling. That was followed up by BCBS 239, you know, the principles of risk data aggregation that told us all how we're going to deal with the silo mess that existed and begat data governance, right? Almost all the banks adopted data governance. And now we are at the point where we have the Financial Data Transparency Act that's specifying semantic standards, you know, standards that do not lose their meaning and are not stuck in their rigid technical structures. And I think that is a huge breakthrough. And that's where we're seeing an awful lot of progress. The banks are moving in that direction. FDTA says we should all move in that direction. So I am hugely optimistic that that breakthrough in standards for data, for meaning, is going to drive the next activity of transparency.
Almost that the foundational level needs to be agreed upon before you can even start to do the analysis or start to do the collection. You have to everyone has to understand what we're talking about.
Absolutely correct.
Agree on the definitions.
So at the foundation, there are kind of only four big buckets, right? Instruments, you know, what they are, how they work, and how do you identify them. Legal entities, who owns who, who's obligated to who finances who, who's left holding the bag at the end, including controlling interest and obligations. The role you play in the transaction, you know, whether you're an issuer or a guarantor, et cetera, and what's holding in the book of the banks. That's the foundational infrastructure. Instruments, entities, obligations, and holdings. And that's what we're still kind of focusing in on.
Sandra, how would you characterize the relationship that you all have with industry in terms of trying to reach consensus on some of those issues?
Yeah, I mean, I would say, one of the things we've been trying to do at the FSOC over the past several years is improve our external engagement with industry and the private sector. But I would say that the council itself doesn't really engage directly with the private sector, let's say on data standards. And I think as Senator Reid mentioned, just like the importance of the agencies and their efforts to do that. And I would reflect your comments on the act, which I think would be very helpful going forward.
Great, Kate.
On the industry, responding to Michael really quickly, I actually love the optimism, and I still want to be optimistic as well. But it's at times hard. It's hard. I mean, I think that's part of like the theme that's come throughout today, and it's where actually I think Alan started us. Is he like part of the vision was this thing should actually make everybody better off. Like the more we manage to actually implement meaningful and useful data standards, it's going to ideally over time reduce regulatory burdens by creating more standardized forms of reporting. It's going to enhance the ability of private institutions to engage in healthy risk management, and it's going to enhance how much regulators know and increase their awareness of how much they might not know because they actually understand the data that's going in and the outputs that are coming out. So I was among the many people who thought okay, the OFR is just one of the most important and critical outgrowths of the 2008 crisis and the Dodd-Frank implementation afterwards. And I think it's more than just the OFR that has made that process challenging. I mean, if you look at kind of what the SEC has gone through with the consolidated audit trail, it's been a decade-long and very difficult and painful journey. And that doesn't mean that it's not still the right journey to be on. I mean, I think it is the important journey to be on. I think the information remains as critical as ever. But it does seem like we need a little more humility, perhaps, that the process of developing these data standards and trying to implement them is a little more like a home renovation, where it's always going to go kind of like well over budget and over time relative to whatever you're expecting going in, even if there's going to be something meaningful on the other end, which again doesn't mean that we don't have to do it all. But I was interested when the Financial Data Privacy Act, when you look at it, I mean, it's got that tone of optimism of, this is going to be easy because it's going to make everybody better off. I mean, the end of LIBOR made everybody better off, and I think we're glad we got rid of it, but it was not a painless process.
But Kate, the good news is the standards, the semantic standards I'm talking about are mature, right? They are web standards. They were developed in the early 90s to be able to identify things, describe things in a granular way, and connect them together and express them in a standard way that can be shared. So I think that it is that maturity that we've gone through, and there's a lot of confusion out there amongst the stakeholders of what it is we're actually talking about. And I did a couple of interviews before this session. From a bank perspective, standards basically means policy. This is the policy of our bank. This is our authoritative data sources. Thou shalt not change anything, etc. From a technology perspective, standards mean format and data exchange, so it's schema-driven. From an analyst perspective, they're on Alan's camp. They're all doing cash flow analysis. And really what we're talking about is standards for the identification of things and standards for the meaning of things. And those are the standards, I think, that we need to focus in on. So they are available, they are mature, they are proven, they're in play in almost every information-intensive organization. So as long as we can overcome the organizational inertia challenge that you were referring to, I think the pathway looks pretty straightforward.
Well, how do we overcome that organizational inertial challenge? I mean, it seems like there is consensus that, I've lost count how many years it's been since the financial crisis now, but over a decade after the financial crisis, that we are still, sort of talking about what needs to be done, and that the implementation of certain processes might be slower than people want to see. So how do you speed up the system? Does it take act of Congress? Does it take more aggressive regulators? Does it take more compliant industry? Which of those levers needs to move?
I've done this research.
Okay, well, let's hear it.
It's not that great a story. I guess you can joke about it and say fear, greed, and regulation. Fear of missing out, greed and regulation are still the drivers. Regulation is always great because you ain't got no choice is a darn good business case. That's why I hold a lot of credence in what's going on in the regulatory process. I mean, let's recognize that BCBS 239 changed the game for data management globally. It just absolutely was a miracle to change the game for implementing core data management and governance and chief data officers around the industry. And I hope that FDTA can do the similar thing. The good news is the banks suffer from the same problem. They want interconnectivity across their activities as well. They would like to achieve straight-through processing. They want to free up their analysts to do innovation and follow their own nose in their development. And they are all building this semantic layer right now, at least the GSIBs and DSIBs that I speak to. So I think it's going to be a combination of this is the way the digital world is going to be built on semantic standards. Regulatory drivers have the need for systemic risk, and the mechanisms exist, and the banks are doing it because it makes good business sense. So those are the building blocks.
I think I would agree with that. I would also add, maybe it's not very sexy, and maybe I'm a lawyer, but I agree with governance as well, and just the importance of that. And one thing that the council's done across the range of issues that we're focused on is we talk a lot about capacity building and the need for agencies to invest the resources, identify this as a priority, and put the resources towards something. And I do want to acknowledge the work of the OFR with respect to JADE, which Senator Reid mentioned, their joint analysis data environment. As he referenced, the OFR started that to help jumpstart the climate data work, to support the work of the FSOC. And they've made great strides in trying to think about how to leverage their capacity, their technology, their tools to make it not just about climate. And so I would say, again, it's not very sexy, but it's like, getting the technology, thinking about the governance, getting the resources, getting the right people, connecting the dots, and I think that's been really, really helpful in terms of making progress on the climate side. And again, our hope is for broader issues that we're going to be covering.
Well, let's stick with the climate component for a minute, because one of the things that, as I was sort of thinking about this panel and this discussion today, is that we've been talking a lot, obviously, about financial markets. It's in the title of the panel, but that the universe of information that we now understand can impact financial markets seems to have grown dramatically, climate being one of those. So how do you begin to reach that consensus around what type of data needs to be collected and how you collect it and how do you standardize it and what do you even call it, and is climate even something that regulators should be looking at?
Yeah, so maybe starting with the last thing, I would say from the FSOC's perspective, we do really try to, again, of course, our mandate, as I said earlier, financial stability. And so we're very focused on that aspect of climate, not more. And it's really thinking about, how do physical and transition risks in the climate space, impact financial institutions and financial markets? And, how can the council do a better job of identifying those risks, right? How do you take those two types of risks how does it translate into the more traditional, liquidity, capital, et cetera, type issues, leverage? So the council's been focused on that. And so what we've been doing is, again, bringing all our agencies together under a new climate committee. It's a lot of blocking and tackling, right? Like you get people who are thinking about risk, you're thinking about data, you think about how can we work together? How can we reduce duplication? How do we get those standards so you don't have the regulators coming up with 15 different standards, and that's what the council has been trying to do. You can't do it overnight. It takes quite a bit of time, but we're making efforts in that regard. And I would note that, our climate report, again, that came out a couple years ago, really focused on the need, again, the data piece, and also how can we work together to identify critical key risk indicators so that we're sort of identifying what are the potential right metrics. And then once you, again, hopefully get consensus around that, what's the data that we need to measure, what level of risk is. So again, it's very much an iterative process. I do talk about, sometimes I feel like my job is herding cats, but I do think it's definitely in furtherance of what we're just talking about.
Can I jump in on that? Because I think it actually connects to your question also over how you overcome some of the structural challenges, or at least how you make progress. I mean, I think the JADE initiative is a great example here, and there's still a lot of additional work to be done. I mean, but part of what we saw is they used, or really, the energy there is right now around climate-related risks, not to say we're going to invest in something that is really just specific to climate, but instead use that as a way of building infrastructure that will initially be used to deal with the challenges that this administration, I think, has identified, broadly speaking, but then can also be utilized, once you have it, to deal with other risks as they emerge. And I think like that type of long-term vision is going to be key in this overall area. It's something we can't take for granted, but I think it also goes back a little bit to the comments we got from Senator Reid about independence. And there's a lot of reasons you have independence and a question of what it looks like and what it means. But I think there you actually have like a little bit of a balance, right? It's that like something is actually getting done in part because it's building off of something that is an administrative-wide priority, and that's actually creating energy to make things happen, and you have broader buy-in and greater opportunities for coordination as a result of that. On the other hand, you have ideally a structure where you're going to be able to make investments and put the pieces in place that are not going to be specific to that, and so there is that longer term component. And one way of understanding kind of the importance of independence is just that you can also engage in kind of long-term planning. If you have constant changes in terms of leadership and in terms of priorities, you're not able to engage in kind of the long-term planning that you actually need to be able to make progress on any of the problems that we're talking about today. So I just think it is one of those ones that kind of in some ways is in tension, but also kind of maybe illustrates the virtue of the fact that it's sitting as both part of Treasury, but also with some degree of independence.
This is just simply a definitional problem that we have to deal with. Let's recognize that data represents real things, and the components of ESG are real things that can be expressed in a granular way. So you model that with all of the SMEs and stakeholders involved. You express that as an underlying foundational standards. Ontologists do all that. And then you take the rules of how do you assemble these things, whether you're looking at it from a supply chain problem or from a regulatory problem or from a financial problem, and then you look at, and that's the risk goal. So this is really just the same problem as every other one, which is let's recognize climate and ESG are real things that can be expressed using standard approaches.
Is there a challenge, though, in the interpretation of the data? And I asked this specifically around, I mean, there's always a challenge in interpreting data, but I asked this specifically around climate because the science is also changing. Our understanding of what it's going to take to reach net zero, et cetera, and the impact of emissions, all of that is also a moving target. So how do you create an infrastructure of information when the data points keep shifting?
I think we have to make sure that we're not conflating the analysis goals with the underlying data infrastructure goals. Right? The data is really straightforward. How you assemble it, what it is. The problem we have with data right now is we have the same thing using different words, the same word that means different things, nuances that aren't passed between the processes, and that causes our incongruence in our analysis. If we deal with that data problem, then the rest of it becomes the analyst's objective. What are you looking for? What do you want? Do I have trust that I'm getting it? And can I assemble it in a way that will give me some insight into the question I have? So we just have to separate out the underlying data objective from the very difficult analytical objective, and I think you can get continuity.
Part of the title of this panel is looking at both the benefits and the risk of data collection and standardization. We've talked a lot about where the potential benefits could be and where we're already starting to see them. What are the risks that you're most afraid of? Obviously, there's a repeat of a financial crisis. But where do you all see, I'll open this up to everyone, where do you all see the need to shine the brightest light right now? Sandra?
Sure. I think that there's So obviously the FSOC is responsible for the financial system, so I don't know if I'd want to necessarily pinpoint one area, but maybe I would just kind of go back to the key themes I talked about earlier in terms of our four priorities, treasury market resilience, non-bank financial intermediation, climate, and digital assets are probably, our four priorities, so we're very focused on those. I would note that, the non-bank financial intermediation is an area that is a bit more opaque, and I do think, as Senator Reid said, I think there's value in continuing to really try to work to get more data in that space.
Is there something that keeps you up at night when you guys are doing your tabletop scenarios and you have a sort of nightmare moment that you think about at 1 a.m.?
Everything keeps me up late at night, so maybe I'll just leave it at that.
Lisa's so good at your job. Go ahead.
For me, it's overcoming the organizational inertia that is preventing us all from achieving change. And we have a fear of change. We have confusion over goals. We have something that I have called the 4 horsemen of the data management apocalypse, which is ignorance, arrogance, obsolescence, and power that run rampant through most organizations. And if you can deal with that problem of the organizational barriers to adopting what are obviously clear, proven pathways forward, then I think we are in better shape. The interesting thing when I was sitting on all these regulatory advisory bodies, you're not going to be able to predict human behavior. We should try as hard as we can, but you're not going to do it. Humans are going to come up with something. We have to have the tools that say, when something happens, can we understand what it is, who was affected, what does it mean in real time? That must be one of our primary objectives.
I'll jump right off of that. So first of all, I really like that last part because there is always a question when we're putting all this in place, and part of what we're worried about is systemic risk, which we've been talking about a lot today, is are you doing it to try to avoid bad things happening, or are you doing it to try to contain the fallout? I mean, if you actually look at the research on bank capital, it's surprisingly more mixed than than I would have expected it to be in terms of, is this actually going to prevent a financial crisis? But where it's really robust is that you have a much shallower recession following a financial crisis because banks are in a much better position to be able to continue to extend credit, and so you actually have a much shallower harm that flows from it. So it doesn't kind of increase stability necessarily, but it really does enhance resilience. And I think what you just said highlighted one of the ways that when we're thinking about kind of what are we doing with data, part of what we're trying to think about is how we enhance the resilience of the overall system. And personally, I think the overall language, even though we still talk about the Financial Stability Oversight Council, and I know that was the rhetoric that was around at Dodd-Frank and is now embedded in the system, the shift to thinking just about stability of like, how do we avoid anything going wrong, to thinking instead about resilience of things are going to go wrong. How do we make sure we have kind of the infrastructure in place to reduce the fallout when that happens, I think has been a healthy one. So I like that you said that. Actually, when you were talking about the risks, I heard it in a completely different way than you then followed up on, because I thought you were trying to say, well, what are the drawbacks of overall going down this road?
We can talk about that too.
And I think generally there's just benefits, but there could be some drawbacks that are worth acknowledging. Anyway, I do think right now cybersecurity has to be an issue, and so the more data that the government has, you do have to think about how you're building a secure environment in which, and again, I think there's been a lot of progress and a lot of awareness, but I don't think that should be ignored as a challenge. I do think there's costs and industry pushback, and so the question is like, where is it you want to have your fights, which doesn't mean that you don't have them. You just have to figure out kind of which are the fights you want to have and why. And the last thing I'll mention, only because India's come up in both of the other panels, is kind of this model that's ahead of us in managing to have great financial data, not only at the level of entities, but also at individuals. I do think that actually, I love all the conversations around AML and sanctions, and I think that there is a lot of payoffs for this work in those spaces. On the other hand, I think we have expectations of financial privacy in the United States that are very different than in other countries. So just because a country is able to know everything instantaneously and the government can know a lot more quickly doesn't mean it's a model that the U.S. can readily follow.
Kate, I want to pick up on something you said, which I thought was interesting, is that, data doesn't necessarily increase stability, but it can certainly enhance resilience. Is that a sort of tacit acknowledgement that our information is inherently backward-looking and it's incredibly difficult to use data to be predictive and to foresee where the risks are going to be, that the best we can hope for is like to build a better bunker?
I mean, I'm still hopeful enough to actually think that better data and better information and better analytics can have virtues both in terms of making crises less frequent and in terms of resilience. So I'm not ready to, I wasn't trying to like forgo. I was saying that there's like kind of like two different dimensions here. But I do think that there is kind of this constant challenge of not only what, like, do you have the right data, but are you looking at it through the right lens? And that's where actually when you're using the SVB example earlier, for me, that's more of a challenge, not of a, was the data available? I think there was plenty of information that was available about the composition of the depositors, about the degree of interest rate risk and duration risk. The challenge there was kind of the inability to take a step back or, other impediments potentially to taking a step back and seeing the forest from the trees and being able to have the degree of concern that the situation actually warranted.
A couple of things. It's just data. I mean, a data is a tool. Let's not elevate it to any more than that. It's an important tool because it's the outcome of all of our processes and all of our activities, and it represents the things that we use to operate. That's different from how we use it. And the models might be terrible. The models might be great. We might be good at predictive analysis and we might be bad at predictive analysis. That's not necessarily the data problem. We want to make sure the data is available, trusted, interoperable, reusable, all the FAIR principles that exist so that the analysts, and there are lots of great analysts, can use this data and look at it from multiple viewpoints. So our problem, and I think you alluded to this, Kate, was not that we didn't have data. We had lots of data. We just couldn't harmonize it. We couldn't align it, and we still have that problem. So we got to figure out how to address that core problem of giving, of trusted data as the resource for the analysts to use in their predictions.
One of the things that everyone in Washington is talking about now is AI and how AI can be used as a tool and how AI can also present new dangers. Sandra, I'm curious, how are you all at FSOC thinking or using AI at all in either collection or analysis?
So I would say that, just speaking for the council within the Treasury Department, we're not utilizing AI at this very moment. But I would note, last year AI was a topic in our annual financial stability report. And it's something that obviously is on everyone's minds, and it will continue to be something that we're going to pay attention to. You talked, Elon, about the benefits of AI, like innovation, is it working faster, et cetera. But of course, our job is to think about the drawbacks as well. So that's something we're definitely going to be paying more attention to.
Kate, how are you thinking about AI?
I think it does raise really interesting questions in connection with the conversations about data standards and collection over should we think about kind of the importance of standardization as co-determined with the analytical tools that you have available to make sense of that data. And one of the things we spent a lot of time on today is just the incredible coordination challenges that can impede the process of standardization, even when standardization would make everyone better off, which is not a reason not to continue to pursue that. But I do think not necessarily AI in its current form, but what it represents in terms of the way the analytical technology could potentially further develop. I think there are reasons to think that maybe trying to figure out how to work with data that is available, create different ways that data can be collected, and then figure out, do we have analytical techniques that allow us to make sense of that data, might over time create either new horizons of possibilities or make decisions about where you want to press on standardization look a little bit different.
It's inevitable. It's here. You're not going to stop it. You're not going to put it back in the bottom. I love it. I use it all the time. But let's remember that artificial intelligence does not exist. There is no intelligence in any of these AI activities.
It's just artificial.
It is just keyword searching and proximity searching and all kind of other techniques that we use. So it's only as good as the data that goes into it. So we must make sure that the data that goes into it is trusted, defined, et cetera, et cetera. because the value proposition from it is overwhelming, right? For mapping, for coding, for the speed of analysis, for being able to do things that we can't do because it just takes a long time to look at every little detail. This is a wonderful innovation, but we have to make sure that it is kind of trained on the content that we understand, trust, and want to use in our analysis.
Is there a danger of AI misinformation seeping into financial data at all?
Yes.
Okay. Be on the lookout.
The problem with AI is it has no intelligence. It doesn't care whether the data is right or wrong. All data is right. So it'll spit out whatever it can get its hands on that meets the vectors and all the things that the scientists are creating for it to do. So it hallucinates. And that can be very dangerous when you are talking about portfolio management or benchmarking and indexing and risk analysis. Those can be very, very dangerous problems. So that hallucination is something that we should really be careful about.
A financial crisis stemming from an AI hallucination is definitely something that would keep me up at night at 1 a.m.
Yeah, the Flash Boys and the Flash Crash was a good example of that.
Yeah. Well, I want to open up the discussion to the audience as well. Does anyone have any questions for our panelists? I see a hand in the back of the room.
Do I go first? Okay. Hi, I'm Courtney Deegan. I'm a reporter with Pensions and Investments. One of the things that I've reported on recently with FSOC is its finalized guidance, which changes its process for designating non-banks as systemically important. So this question is for Sandra. How would you respond to industry concerns that the new process was unnecessary and eliminate some steps previously in place before moving toward that designation?
So it's not quite a data topic, but maybe with that, I would just say, just for those to provide a little context, last month the council issued a new framework on financial stability, risk identification, sort of a new framework. Again, it's just guidance. And the other document that the council issued was proposed revisions to its process for designating non-banks. So that's just for background. I would say just at a high level, and the secretary talked about this in her remarks at the November meeting, the goal of the council is to, when it identifies a potential risk to financial stability and a vulnerability, that the council should have all the tools at its disposal that Congress gave it. And the non-bank designation tool is one of those tools, together with its ability to make a Section 120 recommendation, to work closely with regulators, which it does every single day. And we have additional authorities, let's say under Title VIII, et cetera. And so the council's focus was really to ensure that it had the ability to use the tool if necessary. And that really was the goal of the action. So maybe leave it there.
Can I jump in on this quickly?
Please.
I mean, because it's not related to what we're talking about today, but I do think it's part of the overall network. I mean, going back to the conversation over, we're facing a challenge where we have prudentially regulated banks that are imperfectly prudentially regulated, but where we still have a robust tool set, to the fact we have this continual growth of the non-bank financial intermediation section, like domain, that is not subject to prudential regulation in the same way. And data is one of the ways of trying to provide some additional insight into what's happening to that domain, provide some horizontal insights into kind of where there might be concentration or other types of risks. But designation was another key tool. And I've spent time both with the original act and with the revised guidance. And I do think, first of all, the revised guidance bring incredible analytical rigor. And we provided a framework for the first time that we actually haven't had over how do we actually go about thinking about systemic risk, both with respect to entities, but also kind of in other forms that it might become manifest. So it does have incredible analytical rigor. And in terms of the process, I think what it really tried to do, at least in my reading of it, is really return the process to the spirit of what Congress embodied when they gave FSOC designation as one of its critical tools. So I think there's still incredible rigor, both in the process and in terms of the analytical framework. It is true that under the Trump administration, there was guidance issued that put a bunch of additional processes into place. But we currently don't have a single designated non-bank financial institution, despite the fact we keep talking about how significant this area is, nor was there obviously one under consideration under the guidance that was previously in place. So I don't think that doesn't necessarily tell you anything for sure, but I think there's reasons to think that trying to create a process that was more in the spirit of what was intended, particularly when we think about how central that tool was to dealing with the regulatory perimeter challenge. I mean, so really, again, we've talked a lot about how the data was trying to deal with like the Lehman Brothers, like who are all the counterparties we don't actually know, so that exacerbates the crisis. Here we have the problem of Bear Stearns, AIG, and Lehman Brothers, all outside of the prudential framework, but posing threats that either required government intervention, or when the government opted not to intervene or wasn't able to intervene, we had systemic consequences that were far from optimal. I mean, so it was a real problem that this was meant to address. So I just think that it's important to understand that alongside what's going on here as part of an overall effort to make sure you have the broad set of tools and you're not using the wrong tool for the challenge, but instead you're making sure that you have kind of a variety of different tools for a variety of different problems.
Just real quick, if I may. The problem is the designation carries with it some real burdens. You know, capital reserve and reporting requirements and the whole manufacturing process you have to go to produce a report that, of course, as Alan pointed out, nobody uses. I think, however, we can solve this problem by making it easier and eliminating some of those roadblocks. So the regulatory analysts should have access to everything they want, but they should be able to do it from a granular perspective. So it's not the same thing that the banks want. They look at the world from their own lens. The regulators look at it from a different lens. So if the data is granular and defined, the regulators can ask for what they want, and it's not a burden to produce. They can go off and do their analysis. We have this current process of the difficulty of manufacturing that we have to get over.
Great. I want to take it to all the way in the back.
Hi, Luke, economist with H Data. When we're talking about setting a semantic standard and promoting interoperability between all these different agencies, I'm wondering when we talk about that, how granular are we getting in setting that standard? So I'm thinking, are we going to the point of like the poor accountant who has to figure out, hey, my company just bought an NFT, where the heck do I put that in the balance sheet? Or are we going to a more higher level saying like, hey, when the FERC and the SEC and the FDIC are talking about setting line items in their cash flows, they just happen to harmonize which line items they're including within their cash flows. So I'm just wondering how granular when we're talking about this, and I say that question from a point of concern of if we go too granular, are we promoting rigidity in the data standard in a negative sense and not being flexible enough in when we get new information, new technologies that may change how we're accounting for things?
It's a great question. The data should be as granular as it can possibly be at the attribute level because it's the building blocks of everything else. Let's not confuse the data with the calculation rules, the accounting rules, the other rules that we have in place to be able to assemble that data. So if we collect the things, you know, the facts about the things and the relationships that are associated with those things, then we can assemble it and look at it from an accounting perspective, legal perspective, financial perspective, any perspective you want. So I think that the data standards themselves should be very granular. The rules of how they assemble are a separate matter that are done by the activities.
Okay. One question up here.
Thanks. Jeff Braswell, Tahoe Blue again. I would just like to maybe comment that the data problem of granular data is desirable, but managing lots and lots of granular data creates privacy issues as well as operational issues. And I would suggest that there are ways of actually compressing financial information to preserve the DNA of the underlying structures without revealing all of the underlying contracts, but giving you a much better, BCBS type of roll-up of data in an obfuscated form that actually is equivalent to saying take a 16 megapixel image and reduce it to 100K JPEG. And that is the level at which most of this would eventually work in the end. There are solutions in this area, just FYI.
the benefit is data point entitlement. So you can restrict the data however your rules entail. The data itself can be entitled at whatever granular level you want. So I think that it really becomes more of a rules perspective than it does data entitlements perspective.
I'll try to sneak in one last question. There was someone in the back who had a hand up. Okay, someone's waving very enthusiastically, so if we can make it quick. Thank you.
Yes. My name is Jan Klein from the Actis Foundation, and it seems to me that we've been approaching this conference from the standpoint of financial sustainability, resilience, and risk management, and the need for data in that perspective. From a regulatory perspective, do you think don't the banks see the need to do this themselves? The banks have classically gone through an incredible amount of mergers. Their IT system costs are ridiculously high. They're totally inefficient. I had a refinancing of a mortgage. I got 5 different mortgage closing papers over the course of 2 years. They're trying to figure out what it is. What's your perspective about the banks? All the banks have silos in terms of there's the mortgage group, there's the CD group, there's the commercial loans, and their systems probably don't even talk to each other. What's your perspectives of where the banks are, where their heads are on this, and what they see as the needs, and why aren't they embracing this more aggressively?
How can we help him get a better mortgage rate?
That's actually, I think we might be moving in that direction, but that's a different conversation.
Wait till 2024.
I mean, I think transitions are incredibly difficult, even when there's really significant payoffs. I mean, that's part of what we saw with LIBOR, right? It was an inherently faulty rate. Nobody would have said otherwise. I mean, the actual transactions, particularly longer-term LIBOR, were like minuscule. The reference was huge, and yet there was no effort to migrate away from it, or at least no meaningful effort to migrate away from it, even when those deficiencies became clear and it was clear that there was actual abuse. And so I do think it kind of goes back to the earlier point of regulation. Sometimes regulation is regulators want to change kind of the outcomes relative to what private parties want. There are other times that you just have an incredible coordination challenge. And it's amazing kind of spending time in the space how oftentimes there are some people within the banks that really want the regulation because they see all of the benefits, but they also are not going to be able to be in a position to be able to make this the top priority of kind of the things that are being focused on and prioritized within the institution in the short term. So I do think it's just a reminder that one of the important roles of financial regulation is even when there's long-term alignment of incentives, the process of getting there can require some meaningful regulatory nudging.
Michael, final thought?
Don't forget the 4 horsemen of the apocalypse. They do run rampant through the organization. I am currently working with 4 GSIBs. They are all moving in this direction. They are all kind of deeply involved in trying to build a digital infrastructure, digital data infrastructures in an organization. But remember that it's a really difficult task. So at the moment, they are building their inventories, they're doing critical systems analysis, they're getting hold of their taxonomies and trying to get the shape around that. They're doing operational risk, they're doing integration. So there's a lot of foundational work that must be done, but the banks absolutely understand this problem, and in my relationship, they are working hard to address it.
Sandra, Michael, and Kate, thank you so much for your time, your insights, your expertise. We really appreciate it.
So we just have a couple-minute break, and then we'll be back for our final closing keynote with Undersecretary Liang. If I could ask everybody to take their seats. We're ending the event on the strongest note possible, with Undersecretary Nellie Liang coming to share her thoughts. As the Undersecretary for Domestic Finance, she is really driving the process and the substance behind bringing the financial regulators together. As Das Lee said, it's sometimes like herding cats. She would be the shepherd in the process. And I can think of no person more highly qualified to do so. I say that as somebody who stands in Ms. Liang's shoes to some degree, literally, because before joining the Treasury Department, she was the Miriam K. Carliner Chair and Senior Fellow in Economic Studies at Chair, in which I hope to honor and carry her legacy of research, of quality, independence, and tremendous impact. In her career, she's impacted how financial regulation, systemic risk, and financial data has morphed in very deep ways through 30 years at the Federal Reserve, culminating in serving as its first director of its Office of Financial Stability. Coming out of the financial crisis, nobody was more instrumental in operationalizing Dodd-Frank for the Federal Reserve and thinking about financial stability from a quantitative, qualitative, and practical standpoint. She then continued coming back to a stint at Brookings, her research career, which previously extended to the University of Maryland, my home state, and one in which I take great pride at knowing that some of the faculty from the University of Maryland have gone on to have such a distinguished and impressive career as Ms. Liang. And so with that, let me bring her and welcome her back to Brookings. We're welcome to have you back, and she'll share her thoughts, and then we'll close with a little conversation thereafter.
Thank you, Aaron. That was such a nice introduction. I'm not sure. Hope I can live up to that. So I really appreciate the opportunity to come back today, and this feels comfortable home at Brookings. I know there's been quite a bit of conversations about data and progress on OFR and what we've learned, and hope I can contribute to that a bit today, just from the perspective of where we are at Treasury now with FSOC and OFR. So a key lesson from the global financial crisis is that opacity about critical markets and institutions that result from lack of high-quality data can absolutely contribute to financial instability. And because different financial regulators have visibility into different market segments, detecting and addressing financial stability vulnerabilities requires close coordination and information sharing among regulators. And simply put, in a dynamic, interconnected economy and financial system such as ours, regulators just cannot effectively safeguard financial stability or respond to crises if they do not have good data and are not talking to one another. So Congress took this lesson to heart when it passed the landmark Dodd-Frank Act in the summer of 2010. And among many of the important reforms, it created the Financial Stability Oversight Council to identify risks to financial stability and established the OFR to support the council and member agencies in collecting and standardizing data collections. So today I want to talk about how Treasury, with FSOC and OFR, have been approaching data collection, standardization, and risk measurement. I'll use ongoing work in two important areas to illustrate: Treasury market resilience and the financial sector's climate risks. The financial regulatory community, in my view, has made tremendous progress to reduce opacity since the financial crisis and is positioned to advance further due to significant investments it has made in data and analytic infrastructure. And this progress helps regulators and the regulated firms themselves more broadly and the public that we serve. So let me start with last month, and I think Sandra mentioned this. The Council issued its new analytic framework, which explains to the public how it uses regulatory data and data from other sources to monitor risks to financial stability. And the framework details key vulnerabilities and transmission channels that most commonly contribute to risk to financial stability, as well as some quantitative metrics. Vulnerabilities include, of course, those you are familiar with, leverage and liquidity and maturity mismatch, and also complexity and opacity. All of these have been well studied. The framework's discussion highlights how data gaps, such as those from lack of regulatory or public disclosures, or even difficulties in determining activities of institutions, may exacerbate complexity or opacity. And more broadly, the framework makes clear that filling significant data gaps in order to better estimate vulnerabilities is an integral part of the Council's risk identification and assessment process. So to be sure, in the 13 years since Dodd-Frank Act became law, financial regulators on their own and working with the Council and OFR have really improved the quantity and quality of data and increased visibility into some previously opaque market segments. And to list a few examples, the Federal Reserve is collecting for the largest banks highly granular loan-level data and resolution plans that provide key interlinkages information. The SEC has significantly expanded the detail on assets in money market funds and open-end funds, and is collecting more timely data on private funds from Form PF. And the CFTC and SEC now have access to transaction-level data on swaps trades reported into registered trade depositories. So clearly, reliable data are a necessary input into an assessment of financial stability risks. But we know that data production is not costless, both for the entities who report it and for the regulators who maintain it. So how do we ensure we can get the greatest bang for the buck for the data that we need to rely on? And I believe we can most effectively leverage our resources when we adopt a holistic end-to-end approach to data collection and standardization. So the approach starts with a rigorous process for identifying data gaps and unmet needs to monitor vulnerabilities, such as described in the FSOC framework. And then having identified a gap that needs to be filled, regulators or OFR actively consult with relevant stakeholders to develop a process for data collection and addresses regulators and objectives in a way that is efficient and avoids unnecessary burden on the reporting entities. And by being careful in the way we design data collections, for example, by relying on open standards for data reporting formats and variable definitions, we can often improve the efficiency of data sharing and interoperability among regulators. Once we've determined what must be reported, what's needed, we also need to deploy robust infrastructure to onboard, maintain, warehouse, and analyze the data. This infrastructure includes not only physical data storage and server capacity, but also data governance structures that enable us to protect confidential data while also facilitating information sharing among regulators with a need to know. And finally, to the extent feasible, I believe there's great value in making as much data as possible available to the public, subject to the need to protect privacy and intellectual property and prevent market dislocations. So providing data to the public has a variety of benefits. I'm likely preaching to the choir, but academics and practitioners outside the regulatory community have much to contribute to the discourse on financial stability, and access to better data raises the quality of that discourse. It's been my experience that the more people who use a particular data set, the more quickly it improves over time as users identify weaknesses and suggest improvements. There's also a vast academic literature on the effects of public transparency. And this literature has documented many benefits, including lower costs, improved liquidity, and better price discovery, but there may be unintended consequences as well. And we need to be cognizant of these possible consequences in determining how much information, how much to disclose to who and when. So let me turn to illustrate this holistic practice and approach in practice. Let me turn to two current data initiatives, Treasury market resilience and climate-related financial risks. So on Treasury markets. Treasury market is $26 trillion. It's the deepest, most liquid market in the world. It's the foundation for global financial markets. Ensuring that it functions well, particularly during times of stress, is fundamental to safeguarding financial stability. Greater data transparency and new data collections are critical parts of our efforts to improve the resilience of this Treasury market. So during the March 2020 Dash for Cash episode, when Treasury markets became disrupted at the onset of the COVID pandemic, data on Treasury market trading volumes available to the public were very limited. I was here at Brookings. I could see price data. I could not see volume data. So only weekly data on trading volumes then was publicly disclosed, and it was done with a 1-week lag. It's hard to assess how well a market is functioning during stress if you cannot match price data with contemporaneous quantity data. So this lack of transparency, in my view, was a serious gap. So earlier this year, the Financial Industry Regulatory Authority, FINRA, working with Treasury, replaced the weekly reports on secondary market trading with daily reports. These reports also provide information on trade counts and volume-weighted average prices for on-the-run nominal coupon securities. Coincidentally, this greater transparency became available just weeks before the bank failures earlier this year in March, and allowed market participants to benefit from the enhanced information about Treasury market activity during that difficult period. The Treasury Department's been working further with FINRA to enable public dissemination of secondary market trading at the transaction level. We've consulted closely with market participants and other stakeholders on what data could be disclosed without compromising market functioning. We propose to begin by disclosing transaction-level data for on-the-run nominal coupon securities. The disclosures would put caps on trade sizes and have a modest time delay to help prevent strategic front-running and other distortionary behavior that might reduce market integrity. And last month, FINRA submitted their proposed rule filing to the SEC to move forward with this transaction-level dissemination. If the rules go forward, we will then assess over time the effects of these disclosures on the market and consider possible steps to provide additional transparency for other securities. We've also made very significant progress in improving regulators' visibility into the Treasury repo market. So a vibrant Treasury repo market is important, fundamental to a deep and liquid Treasury securities market. As we saw in the global financial crisis, repo markets can be subject to run dynamics. And financial regulators have done much since then to improve regulators' visibility into this market. But some key gaps remain, and we are actively working to fill those. So the Federal Reserve now collects data on tri-party repo transactions, and the OFR collects data on centrally cleared repo transactions. But currently, no one is systematically collecting data on the non-centrally cleared bilateral repo market, called not very easily NCCBR. But this market is a $2 trillion market. It's the largest segment of the Treasury repo market. It represents dealer-to-client transactions and may feature significant borrowing from dealers by leveraged actors such as hedge funds. The OFR turned its attention to closing this gap and conducted a pilot collection in 2022. And in January of this year, OFR proposed a rule to begin collecting these data on an ongoing basis. The proposed collection would provide daily transaction-level information from financial companies. These data would allow regulators to monitor this market in near real time, which could help identify emerging market vulnerabilities. The OFR received multiple comments, 30 comments on its proposed rule, and public feedback is being used to refine the final rule, which OFR expects to publish in coming months. This data collection will require that OFR manage data submissions from reporters, high volume of data submissions from reporters on a daily basis. And to support this data collection and other projects, OFR has developed a data collection utility called the DCU. And the DCU is an efficient, cost-effective tool for data collections, which will allow OFR to securely collect and store business confidential data or even address large-scale bespoke collections. This will provide flexibility for financial industry participants and other data reporters to provide both automated or manual submissions. And looking beyond this particular data collection for the bilateral repo, this utility positions the OFR to respond quickly to the FSOC's evolving data needs through pilots, surveys, or other collections. And this data collection utility will become operational in early 2024. Let me just turn to a second area where Treasury is working to improve financial data and analysis, and that's risk to the financial sector from climate change. This started the conversation following up on the previous panel. Some climate data needed to measure risks, such as information on acute physical risks from wildfires and hurricanes, or more chronic physical risks like protracted excessive heat, they already exist. Other data, such as emissions data from borrowers, used to help identify financial firms' exposures to climate transition risks, are still being developed. And for regulators and researchers who are accustomed to analyzing more standardized financial data, the size, complexity, the formats of these climate data sets makes them very difficult to work with. In 2022, the OFR launched a pilot program to assess the feasibility of creating a collaborative research environment with data and analytical tools for assessing these kinds of climate risks and matching them with financial data available to FSOC member agencies. And following the successful completion of the pilot, this project has been permanently launched as the Joint Analysis Data Environment, or JADE, which was mentioned earlier. So JADE's a high-performance computing platform that will enable collaborative, interdisciplinary research by providing FSOC member agencies access to data that is analysis-ready and analytical software in a secure, cloud-based environment. JADE integrates processes and protocols to ensure data privacy based on those that OFR has developed and refined over the years. These processes and protocols ensure only those with the proper permissions in agreement with the providing agency are allowed access to data on the platform. Currently, JADE hosts a mix of publicly available climate and financial data. For example, it includes information on the geography of flood and wildfire hazards, as well as information on the geographic distribution of mortgage loans that might be exposed to those hazards. And providing these resources in a collaborative space enables FSOC member agencies to focus on their analysis and research rather than individually obtaining the necessary resources to build this environment. Currently, in addition to the 2 pilot participants, a number of other agencies have gained access to the platform, and there's plans for more to join in the near future. And in addition, OFR is planning for JADE to accommodate other data and analytical software and support research on other financial stability topics that arise. On climate data, we're also working to expand the data we collect to fill an important gap to evaluate and monitor the impact of climate-related hazards on households and real estate markets. We've all seen the headlines about spiking homeowners' insurance premiums or limited insurance availability in places like California and the Gulf Coast that are struggling to cope with the rising economic costs of wildfires, hurricanes, and other climate-related hazards. Many of these physical climate hazards tend to have highly localized effects, and the risks from these hazards depend on local geographic patterns such as migration and development. To understand how physical climate risks affect property insurance markets, regulators and researchers need to know how the availability, price, and loss claims on insurance policies vary across local geographies, but current data are only available at the state level. To address this gap, in October 22, the Treasury Department's Federal Insurance Office, FIO, sought public comment to collect geographically granular data on multi-peril homeowners insurance. Since then, FIO has received many comments, carefully reviewing them, and is engaged with numerous stakeholders, including the NAIC, state insurance regulators, insurance companies, and consumer groups. And based on these discussions, FIO has streamlined and refined its data collection request to facilitate a more effective implementation of its first ever data collection. Last month, FIO announced it would seek formal OMB approval to begin collecting insurance data at a zip code level on a consistent, granular, and comparable basis from the largest homeowner insurance providers that collectively underwrite around 70% of homeowners' insurance premiums nationwide. These data will help regulators and analysts to better understand how physical climate risk influence insurance coverage and availability for homeowners, the potential knock-on effects for mortgage lenders and for real estate markets, and hence financial stability risks. So let me conclude. I want to emphasize that we at Treasury and in the broader financial regulatory community understand the critical importance of data to our financial stability mission. Collecting and maintaining data for analysis is a critical part of that work because we can't manage risks if we can't effectively measure them. The examples I presented today are ways we're using data and infrastructure to improve the resilience of Treasury markets and to better understand climate-related financial risks. And they demonstrate our holistic approach, identifying gaps, consulting closely with stakeholders, building the infrastructure to collect, store, and analyze the data, and work to share data among regulators, and where practical with the public. And in this way, we're working to improve both the extensive margin by expanding the data we collect and the intensive margin by using our data more efficiently to advance our financial stability mission. And my last comment I want to make is we could make further progress on our OFR mission and our financial stability mission if we were able to get a director confirmed in the Congress. So with that, let me conclude. Thank you.
Well, I couldn't agree more with your last point, and I think Senator Reid echoed that in his remarks and seemed energized to go back to the Senate and do the important job of confirming people so that you can have your principals and your folks there. It felt a little bit like a superhero tale with the DCU and the Jade. It's like you're assembling the Avengers and you're trying to get one of them through, Spider-Man stuck on the plane, trying to get on the plane. Undersecretary, you've experienced bank failures at the Fed in 2008, now at the Treasury this spring. I feel like I got to have some of that joy when I was in the Senate Banking Committee and then at Treasury in different sides. It's not fun. Yeah. It may be fascinating to live through. In between, you're at Brookings and other research organizations studying how regulators should build a framework that is more resilient and structurally sound in the face of incidents that create turmoil and crises. How important is it to have real-time access to high-quality financial data in achieving this agenda? And how would you think about the amount of data we had to understand the risks in 2008 and the quality that we have to understand the risks now, having just gone through the turmoil in the spring?
Okay, let me start first. It's with the quality of data in 2008 and the quality of data now. It's night and day. What we lacked so much data in 2008. Loan level data, and I would say regulators lacked loan level data. The firms themselves lacked loan level data, and I think that's a key element of a lot of our data collection efforts benefit everybody, not just the regulators and the public, but the regulated firms themselves. So I think there's still ongoing efforts by the largest firms to integrate and make all their data usable. That was not something then. We also now have much more data on money market fund assets, something that was missing then. We have a lot of data on the derivatives exposures of who is holding various derivatives contracts. All that, so that's such a difference. This recent episode, and I think I heard this earlier today, it was not lack of data. It was, I think mark-to-market losses are disclosed every quarter. Uninsured deposits are knowable from call reports and other places. So it was more of what's the trigger? There's always going to be a trigger. Is the lack of supervision and effective risk management, which are same issues. Data can't solve everything. It's just an element, I would say. But I think, there could have been a little more data, of course, that you might want going into a crisis. But I think there is now enough data to be able to pull together, at least for the banking sector, what you need to know in real time. It may not be at your fingertips, but it can be put together in a couple of days. And the other piece I want to just emphasize, in a crisis, communication and coordination among the regulators is at least, if not more important than the underlying data. Supervisory data is available. You can pull it together. You may want to do some prep work. I guess this is a point to make, that you want to be prepared for a crisis so that you have maybe protocols in place, MOUs in place, to be able to share information as needed during a crisis. And you don't have to go to find the lawyers to write up all the documents and all that. And so I think you work with the data you have when you start a crisis. You have what you have. But the coordination and communication is at least as important. So I just want to.
Yeah, no. The very first panel kicked off this kind of question: would more data have stopped what happened to SVB? And I think the answer to that is absolutely not.
Yeah.
That's not a question. The question is, would we have had a better understanding of the knock-on effects, the potential impacts on small businesses, the other elements that are going on? Because you're right, data is not a solution for judgment. Mm-hmm. And it's just providing information where you have. what are the consequences of not having the data we need? You talk about, you said something just now that I think is critically important. You start a crisis, you have the data that you have, right? Do policymakers have the luxury of waiting for data? Or you're just, when the crisis starts, you have the data you have and you're going to have to make the judgment on the basis of that data?
I think the answer to that has to be yes.
Yeah.
You have what you have. This most recent event, I don't feel like lack of data was either what led to it or compromised how policymakers responded to it. In fact, we responded to it within 48 hours, I think in a pretty forceful way. Closed the banks, understood what was at the banks, understood the uninsured deposits across many regional and smaller banks, issued a systemic risk exception. In the background, had to write a lot of work, document why this was needed. That was all done within 48 hours. And I don't feel like we lacked sufficient data to make the broad, policy decisions that had to be made. And then over the next couple months or further, as you're tracking what is happening to this sector, because there still are, interest rate risk is still on the books of the banks and at many financial institutions. You can track and you can further develop data. So I don't think that was an issue in this case.
So there's some progress to end on a note here. Let me ask a question that came through from the audience using the hashtag standard data. Faith Wittrall from Macro Peru asked a question online. She said, how do you see AI impacting financial data? And that was a topic that came up earlier as well.
Yeah. So, AI is a pretty fascinating development. Just another development, though, in the scheme of financial innovations. There have been a lot of financial innovations that have affected the financial sector. I think it actually emphasizes the importance of data and data quality. Someone said earlier, it's only going to be as good as the data that goes in. But AI, is it's not really fundamentally different from other financial innovation. It's going to be faster and a little bit harder and more complex, and it'll make regulators' jobs harder and more complex. But there are rules for financial regulators for how to use data, govern data, and use models and govern models. Financial firms should not use data or models they don't understand. That's already on the books. And so you start from there. There are some foundational principles for regulating AI. There's consumer and investor protection, there's safety and soundness, there's illicit finance, there's financial stability. There's guardrails around all those things. Those all apply to AI. Now, like we do for other areas, as we go along, AI might expose other gaps, and then we might want to do more. But I think the approach currently is the way we approach other financial innovation. The president put out an executive order a few months ago on artificial intelligence, which emphasizes the potential role for AI to make huge changes to the way the economy functions. For the financial sector, the key one was and Treasury is working on, is the role of AI-related cyber risks. And that is an area that's about protecting data storage, processing capacity. We're finding as we talk to financial market participants that some of the AI-related financial risks, cyber risks, are pretty much like the cloud service providers' cyber risks. And so there's a lot of overlap, but we'll be doing some more work on that.
Well, I think you're wise to focus on the risks like cyber, where people have a hard time, right? If we'd been here in 2019 and somebody started talking about pandemic risk, folks would have been wondering why, and you know, before focusing on cyber before we're victims of something that's truly consequential, and the frame about AI that we exist. I think AI dominates financial services for most Americans on a daily basis, and it goes by a 4-letter acronym known as FICO. And I've struggled to understand the distinction between quote-unquote AI and what the FICO algorithm determines, and that's full of bad data. I'm still trying to find the Aaron Klein in New Jersey who's didn't pay his bill.
Has a better score or lower score?
So that Aaron Klein lowered my score, but for the company making FICO, all they care about is that the errors are symmetric. If the errors are symmetric, then the data in the aggregate is accurate. And so who cares that there's a group of people for whom credit has become more expensive and more difficult to maintain than their true credit worthiness, and there's a corresponding group that's benefited. You're wise, always thinking, you know, kind of the way the other people are. There's another group of people that have benefited from having their scores contaminated, and cleaning up the data costs money. And so we just go along being dominated by this, you know, horribly out of tune oboe that the rest of the financial orchestra has tuned to, really harming millions of Americans. But that's a subject for a different day. You have a principals meeting of FSOC to go and run
meeting today,
all of the regulators to go and improve their data, guard against risks, make the system better, fairer, safer, and solve the climate problems of the future while protecting us against the cyber attacks from the criminals today. So with that small agenda to do between now and Christmas, let me thank you. And if everybody could maintain seated just while you applaud and let the Undersecretary dash off to get back to 1500 Pennsylvania to make the world a safer place. Thank you.
Thank you, Aaron. Appreciate it.
And as the Undersecretary departs, let me thank each and every one of you for spending your most precious commodity, your time, with us here today at Brookings in the Center for Regulation and Markets. We're dedicated to having these conversations where we bring diverse interests and diverse viewpoints onto topics big and small. I can think of nothing more important than getting the facts and the data right. As multiple folks have pointed out, there will be another financial catastrophe. When that happens, you play with the team you're dealt. You deal with the data in front of you. And if the data in front of you is not high quality, accurate, and easily accessible and standardized, then you're going to make judgments on the basis of inaccurate data or gut feelings. And I think we think as a society we're better off when we do factual-based analysis than make huge consequential decisions on the basis of ideology alone or gut feelings. So in that, I want to thank all of you for being part of this endeavor and wish you all a wonderful rest of the day and a rest of the year. Thank you.